Good morning, students, and welcome you all once again on part 3 of INDES 115 lecture. So, students, in the last two lectures, which was conducted on 22nd of February and 24th of February, morning 7 to 10 a.m. So, we discussed about what is this particular standard, what is meant by revenue, what is meant by contract, and what is meant by customer. Okay. So if these three elements lies in any transaction, in that case only that transaction will be accounted and recorded as per Ind AS 115. And we discussed what is the scope of this particular standard, what is the structure of this particular standard. And we understood that this standard is a single model standard. I mean to say this standard provides a particular 5-step model according to which the revenue is required to be measured, identified, and recognized, right? While discussing the 5 steps, we discussed that the first step is identification of contract with the customer, which we have discussed in detail in the part 1 of Ind AS 115 lecture. And then in the last class, we have discussed about determination or identification of performance obligation. So in the last class, we discussed that what is the performance obligation. So of course, so far we have understood whatever is the promises which is there to deliver goods or services within a contract is known as a promises. Now we need to understand, sir, whether every promise is a separate performance obligation. So depends. So what is a performance obligation? Of course, performance obligation, whether it is a separate performance obligation or it is a combined performance obligation, you need to see from the two aspects. One, whether the goods and services which is required to be delivered to the customer or which is going to be delivered to the customer, whether customer can consume the benefit of those goods and services, either it is own or with the help of the readily available resources. Okay, if the answer is yes, and then you need to see whether the goods and services are identified separately in the contract. Am I able to separately identify those goods and services in the contract? If the answer is yes, then we can say that yes, it is a separate performance obligation. So this is at a goods and services level. But in a contract, you are also required to see, although you can consume the benefit of those goods and services with the help of the readily available resources, but probably as far as contract is concerned, you don't want to do that. Okay, so as per contract, you are required to have this entire benefit from that particular contractor, from that particular supplier. Okay, for example, we have taken an example of water purification plant. For example, construction services example. For example, you are buying a software from a company who is manufacturing the software. Okay, and generally this installation or customization has to be done by the same person who is manufacturing the software, although there are outsider technicians also who can install this particular software. But just think from the customer perspective, right? If there is a customer which is designed by there is a software which is designed by a particular company, then what will be your first choice? Your first choice will be to get this installation done from this particular company. Okay, so you need to analyze whether within the contract is it a separate performance obligation or is it a combined performance obligation. And for that you need to see the three aspects of it. One, you need to see whether this requires a high degree of integration. For example, there are 3-4 promises in the contract, and whether these 3-4 promises requires a high degree of integration. Okay, for example, installation service, whether it requires a high degree of integration, high degree of assembling, high degree of customization, significant modification. Okay, and whether these are interdependent with each other. For example, when you are installing a factory or you are just constructing a factory, okay, and when you are installing a complete assembly line or machine line, in that case you are providing a contract to a single customer, because these entire machineries which is working as an assembly line is interdependent with each other. You cannot say that, okay, so if I'll install 2 machinery, for the next 2 machinery I can hire somebody else, okay, and I can get the benefit, right? But as far as a contract is concerned, you need to see what is the objective of this particular contract as well, right? So probably at a goods and services level, the goods and services could be distinct, but at a contract level, it could not be distinct. So guys, we have discussed this aspect with the help of lot of examples, lot of practical examples, lemon examples in our last lecture. So I would request all the students and participants who are you just watching this class on a live basis, okay, or who will be watching this video after this class, or on a not on a real time basis. So I would request all the students to watch part 1 and part 2 of Ind AS 115 before attending this particular lecture, right? So let's continue with the journey of Ind AS 115, and today is the third lecture on Ind AS 115, and we will be moving towards step 3. Okay, but before moving towards step 3, in the last lecture we talked about 3-4 things in the performance obligation. We understood what is performance obligation, okay, and how this performance obligation has to be identified. Is it a separate performance obligation, or is it a combined performance obligation? Okay, and after that we have discussed the concept of principal versus agent. Okay, who is a principal and who is a agent? If it is a principal, he will recognize revenue on a gross basis. If he is an agent, he will recognize revenue on a net basis, right? And again, we have taken a lot of example from my PowerPoint presentation as well as from the institute study material. Then we talked about a right of return. For example, if a vendor is selling 100 units of goods and he is expecting that 10% will return, of course, whether the 10% return will be whether the 10% return, so whether the revenue should be recognized for the entire 100, or let's say 90, or let's say 0. So standard says that, of course, this right of return is not representing a separate performance obligation, but the expectation which you are having that at least 10% could be returned, you have to create a right to recover asset as well as a refund liability. Okay, so refund liability means if the customer will come and ask for a return within a specified time period, you have to return the money which is equivalent to the revenue, equivalent to the amount which you have been charged or you have been collected from the customer. So there is a refund liability to the extent of sale price, and there is a right to recover asset to the extent of cost of goods sold or inventory, right? So we talked about this, if you remember. Yeah, this example we have done in the last class. Now we are discussing the very important, and even the in case of consignor and consignee transaction, we have also covered that part in the last lecture. So students, I hope you all are clear and loud. So Namita is asking, sir, for these live lectures, ICAI is not taking any consideration from us, as a student. So we are not the customers of ICAI. Namita, you are right. For being a customer, there should be a consideration, right? Because it is a definition of the customer. A customer is a person who obtains goods and services provided by the entity, which is the outcome in the ordinary course of business, and in exchange for a consideration, right? So so ICAI is doing this voluntary, they're doing this, you can say that charity or voluntary contribution for the welfare of the students, right? So Namita, your question is incomplete. You are asking something, if A sells Maruti car to B for rupees 6 lakh. So Namita, I'm not able to understand your query because it is incomplete. So please complete your query. So Namita, you are talking about page number 3.8. Okay, let me look at that. So Namita, you were talking about step 1, identification of the contract with the customer. So let me tell you, this text talks about, you need to analyze. Let me look at my, let me show you my, first of all, I'll quickly cover this aspect, then I'll move on to this option for material right to refund. So first of all, for getting any contract into Ind AS 115, you have to see the 5 steps. Okay. So in the 5-step model, the first step is identify the contract with the customer. And when you can say that, yes, it is a contract with the customer, of course, it should be written, oral or implied. Okay. And it should met these 5 conditions. First of all, the parties must have approved the contract and committed to perform. If the parties have not approved the contract, so this is not a single condition, it is all conditions. So all these conditions needs to be satisfied. If the parties have not approved the contract, whether this contract will be considered as a contract with the customer, answer is no. Okay. So if it is no, then it is outside the purview of Ind AS 115, and you are not required to consider this contract within the Ind AS 115. So first of all, you need to see whether the parties have approved the contract, and you have to wait till the time the parties have approved the contract to take this contract within the purview of Ind AS 115. For example, parties have approved the contract. Okay, then you need to ask the second question, whether parties' rights are identifiable. So there is a contract between myself and Namita that I'll teach Namita and she will pay me, right? But rights are not identifiable. For example, so what I'll teach her, whether financial reporting, whether SFM, whether auditing, so it is not clear, right? What will be the timings? At what time I'll teach her? Is it morning, evening? So that is not clear. What considerations she will pay me? It is not clear, right? So if the parties' rights are the parties' rights should be identifiable. I mean, if it is not clear, then this is not a contract with the customer to be captured in the purview of Ind AS 115. If it is yes, rights are identifiable, then you need to see whether the payment terms are identifiable. If the payment terms are not identifiable, then it is not covered under Ind AS 115. Okay. For example, if payment terms are also identifiable, then you need to see whether the contract has a commercial substance. So Namita has entered into a contract with her friend that I'll teach you consolidation, you will teach me revenue from contract with the customer. So this transaction does not have a commercial substance, right? So you need to see whether it has a commercial substance. For example, two Louis Philippe outlet, they are selling goods to each other. Okay. So for example, a customer came and customer has asked for a 32 size of t-shirt. So that outlet does not have 32 size of t-shirt. So that outlet purchased this t-shirt from the another outlet, and this another outlet is also purchasing some garments from this particular outlet. So they're just exchanging the garments with each other, right? So this transaction does not have a commercial substance. So you need to see whether it has a commercial substance. And for example, yes, it is having a commercial substance. Then you need to see whether the consideration, whether there is a probability that the entity will collect the considerations. Of course, that expectation should also be there. So if the entity will not be able to collect the consideration, in that case, it will not be a contract with the customer to be covered under Ind AS 115, and entity is required to reassess whether this collection probability will met or not. Okay. For example, if the collection probability will not met, then or let's say, for example, there is a contract of 10 lakh rupees and the entity is expecting that we will be able to receive or collect only 5 lakh rupees. So revenue needs to be recognized to the extent of 5 lakh rupees only, right? So this is something which is written there. And sir, what happens if we will receive the full amount, but the parties have not approved the contract, or payment terms are not identifiable, or let's say rights are not identifiable? For example, you have went to a dealer to buy a Maruti car, right? So you have asked dealer, because I still remember the time I have purchased Swift, let's say 10 years back, right? And that time there was 6 months waiting on the Swift car, Maruti Swift car. So for example, I went to a dealer who is my friend, okay, and I asked, what is the price of this car? He said, don't worry, if you want to buy this car, just have this, okay. But yes, there is a high shortage of this car, and the delivery will take 6 months time, this, that, blah, 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 blah. Okay. So I told him, just please take this 5 lakh rupees or take this 8 lakh rupees. Okay. And please deliver this car to me. And since he was my friend, so he took 5 or 8 lakh rupees from me and he had delivered the car, but there was no contract between us. Okay. So he said, okay, just take this car ले जाओ, बाद में हिसाब किताब होता रहेगा. Okay, he said. So my dear friends, in this particular case, the collection has come. For example, the cost was 6 lakh, but since he was my friend, I have given him 8 lakh rupees. That when we will settle, so he'll refund, or if the car is having a price of more than 8 lakh, of course, I'll pay him at the time of settlement, right? So money has come, but contract has not been approved. Okay. Payment terms are not identifiable. Okay. So in this particular case, although fifth condition is meeting the tick box, but the above 2-3 conditions are not meeting. So in this case, revenue will not be recognized and it has to be considered as a liability. So this Maruti dealer will recognize this money received as a advance receipt from the customer, right? So guys, for getting the contract covered under this particular standard, these 5 conditions needs to be satisfied. I hope I have answered your query, Namita. Now I need to move on to the agenda for the day because I have to cover a lot of things today. Options granting material rights. What is meant by options granting material rights? Right. So friends, you must have done the shopping from Superstop, Louis Philippi, or let's say Ellen Solly, okay, or some other supermarket or brands, okay. So when you in the festive season, or let's say at the time of when these brands are giving offers to the customer, so this brand says that if you will buy a goods worth rupees 10,000 from us, we will give you a discount voucher, okay, which you can use in your next shopping, right? For example, I still remember just 5-6 years back, I have went to a Taj hotel. Okay, so I booked a ticket for I booked a room in the Taj hotel, and I still remember at that point of time they have, because they were just celebrating their anniversary, and I don't know which year anniversary it was, and they have given me a discount voucher that, sir, whenever you will come to our hotel in the next time, of course we'll give you a discount of 30% as a loyalty customer, right? So first of all, you need to understand there are 2 kind of discount, right? One, why you got this discount voucher and why you got this discount. You got this discount because you have purchased some goods and services from this particular brand or from this particular vendor, right? From this particular brand or this particular vendor. Because I have done the shopping of rupees 10,000 from Louis Philippi, that is why that brand is giving me a future discount of 30% on my future purchases, subject to this amount, right? The second kind of discount is season discount. For example, there is a discount at the time of Christmas in winters, and there is a discount at the time of summers, which is around June or July, right? Where every brand is giving you a discount. Now the question arises, sir, when there is a seasonal discount, like in the month of June, July, or in the month of December, January, so whether for that particular discount, one has to enter into a contract with the customer, one has to enter into a contract, whether a customer has to enter into a contract, answer is no. So any customer who will visit the shop, who will buy the product of that brand during the season sale, so everyone will be eligible to that discount. For example, 20%, 40%, buy 2 get 3. So everyone, every walk-in customer, every first time customer will be eligible for that particular discount, because that is for everyone. But in my former example, in my first example, as far as the discount voucher is concerned, for example, this Taj hotel has given me a discount voucher for availing the discount in my next purchases. So this discount is only given to me because I have entered into a contract with the Taj hotel by booking a room by booking a room 5 years ago, right? So since I have already availed the goods or services and I have met some conditions, that is why I am eligible for a future discount, right? So friends, now the question arises, sir, if today you are purchasing a goods worth rupees 10,000 and you have paid 10,000 rupees to the vendor or to the shopkeeper, and in lieu of this 10,000 rupees of shopping, you got a discount right. You got a right to avail discount in future. You got a discount voucher worth 40%. Okay, in the next purchases. Right? Now the question arises. For example, in the next time, I'll do the shopping of 5,000 rupees. Okay, so I'll get 40% discount. So 5,000 multiplied by 40%, 2,000 rupees. So whether today I need to recognize a sale of 10,000 rupees, and tomorrow when I will avail this voucher, do I need to recognize a sale of 3,000 rupees? Okay, whether the supplier or a shopkeeper will recognize a sale of 3,000 rupees, and today he will recognize sale of 10,000 rupees. Is it a correct accounting? Answer is no. First of all, you need to understand whether sale of goods as of now worth rupees 10,000 and providing a discount voucher for future discount. Okay, whether these two things are a separate performance obligation or a single performance obligation. You need to understand this aspect. You need to understand this aspect, right? So guys, please tell me, Utkarsh, Namita, Shruti, Priya, Thota, Sai, what is your answer? So whether the goods which is sold by the shopkeeper for rupees 10,000 as of now, and the discount voucher which is given by the shopkeeper for future discount, whether these two things, two activity, two items are a single performance obligation or a separate performance obligation. Yeah, guys, I'm waiting for the answer. Yes, you're right, Utkarsh. It is a separate performance obligation. Why? Because the performance obligation relating to this discount voucher has to be met in the next purchases. Okay, and the goods and services delivered as of now is a separate performance obligation, and the discount voucher will be a separate performance obligation, right? So it will be a separate performance obligation. So if these are the two separate performance obligation, whether revenue has to be recognized as 10,000 rupees in its entirety, or we need to allocate some revenue to the discount voucher, and when this discount voucher will get expired, or when the customer will avail this discount voucher, for example, the customer will do the shopping of 5,000 and receive a discount of 40% of 2,000. So whether 3,000 revenue will be recognized or 3,000 plus the discount, the revenue allocated to the discount voucher needs to be recognized in future. Okay, we will understand this thing with the help of an example, right? But have you understood the meaning of option granting material right of discount? Have you understood this? Yeah, have you understood this? So first of all, whether it is an option granting material right of discount, how will you understand that yes, this is an option to receive material right of discount? You need to ask 2-3 questions. Does the contract grant the customer the option to acquire additional goods or services at discount? Of course, yes. By this discount voucher, I can acquire additional goods or services at discount, right? Does the option provide a material right to the customer that would not receive without entering into a contract? If I would not have visited Taj Hotel, whether I'll get this discount voucher? Answer is no. If I would not have done the shopping of 10,000 from Louis Philippe, I will not receive the discount voucher which I may avail from the next purchases, right? So does the option provide a material right to the customers that it would not receive without entering into the contract? Okay, if answer is yes, the customer does not receive, the customer will not receive a discount voucher without entering into a contract, like in the example of Louis Philippe and Taj Hotel. So in that case, it will be considered as a separate performance obligation. It will be considered as a separate performance obligation, right? But even though every customer will receive the same discount, even though the customer will not enter into the contract. If that is the case, that performance obligation will not be a separate performance obligation. For example, seasonal discount. In case of a seasonal discount, everybody will get the same discount, right? But in case of a discount voucher based on the sales value, so only those customer will get the discount voucher or a discount who has acquired the goods or services earlier. I mean to say, who has entered into the contract earlier. So in this case, it will be a separate performance obligation. So there will be a two performance obligation. One, sale of goods. One is sale of goods, and the second one is discount voucher, which is a right to receive additional discount in future, right? Understood? Clear? So Jay is asking, sir, but sir, next discount is related to the first purchase. So single performance obligation as at contract level may be one. So Jay, the contract, as of now, the contract, what is the contract? So as of now, the contract is to provide goods and services, right? For rupees 10,000. And what is the second activity? The second activity is to provide a discount voucher. So Jay, don't go by the thing that, sir, we are giving goods or services worth rupees 10,000 as well as we are giving discount voucher at the same time. Doesn't mean that these are the single performance obligations. These are the two separate performance obligations. The customer is getting the benefit of these goods and services worth rupees 10,000 as of now, but the customer will get the benefit of the discount voucher at a different time. Okay, so when he will avail that discount voucher. So these are the two separate performance obligations. It is not highly. So when you are looking at a contract level, Jay, just remember these three conditions. Okay, one, whether this discount voucher, I mean to say future shopping and the current shopping, whether it is highly interdependent. If you will not buy the shirt in future, so you will not be able to utilize the benefit of the shirt which you have purchased in the current period. Answer is no. Whether this discount voucher or in the current shopping, is it highly integrated, highly interdependent, highly interrelated, whether any customization or modification is required? Yes. Answer is no. So in that case, even at a contract level and even at a goods and services level, these are the two separate performance obligations, right? Right. So let's understood with the help of this particular example that how, if a company is providing a discount voucher which can be availed in the future discounts, in the future purchases, so how to recognize the revenue in such cases, right? Understood? Clear? Okay. So friends, let me move to my Excel file, and I hope my Excel file is visible to everyone. So in the identification of performance obligation, we are talking about option of material right of discount. Okay, I would request everyone to please prepare your class notes. Please write down these notes. What is the option of material right of discount? The customer will be able to avail additional discount due to the fact that the customer has already entered into a contract by buying some goods and services earlier from the entity, right? The customer will be able to avail additional discount due to the fact that the customer has already entered into a contract by buying some goods and services earlier from the entity. Okay. So in this case, the additional discount which entity is expecting to provide in future purchases will be a separate performance obligation, will be a separate performance obligation, right? Will be a separate performance obligation. Now, if it is a separate performance obligation, then this transaction price, has to be allocated into the two performance obligations. So what will be the two performance obligations? Sale of goods. Second one is discount, right of discount or discount voucher, right? Clear friends? Is it clear? So let me move to the institute study material, then I'll come here and then I'll show you how to do this particular treatment, right? An entity enters into a contract for the sale of product A for rupees 1000, right? As part of the contract, the entity gives the customer a 40% discount voucher for any future purchases up to rupees 1000 in the next 30 days. An entity entered into a contract for the sale of product A for rupees 1000. So the entity is selling a product A which is worth rupees 1000, right? And as part of the contract, the entity gives the customer a 40% discount voucher. So why this customer is getting a 40% discount voucher? Because the customer is purchased goods worth rupees 1000. And this customer can avail a 40% discount voucher for any future purchases up to rupees 1000 in the next 30 days. So this 40% discount voucher can be availed only for the purchases worth rupees 1000, right? So it means a discount of 400 can be given at the max in the next 30 days. The entity intends to offer a 10% discount on all sales during the next 30 days as part of seasonal promotion. So friends, even though if this entity has not provided a discount voucher to this particular customer can avail even 10% discount without entering into a contract with this company, right? Because this entity is providing a 10% discount on all sales during the next 30 days as a seasonal promotion. So everybody can get this 10% without entering into the contract, without purchasing the goods and services earlier from this entity, right? So the 10% discount cannot be used in addition to the 40% discount voucher. So if you have a 40% discount voucher and there is a 10% discount for everyone as a part of the promotion, you cannot avail 40% plus 10%. Okay, this 10% is inclusive of that 40%, right? So first of all, the question arises: what is a material right of discount? What is a material right of discount? Is it 40% or is it 40 minus 10%? So the material right of discount is not 40%. The material right of discount is additional discount. Material right of discount is additional discount is equal to incremental or additional discount. Incremental discount. So what is the incremental discount? If this customer would not have purchased product A worth rupees 1000, still this customer will be able to avail 10% discount. But since this customer has entered into a contract to purchase product A, this customer will receive 40% discount. So what is the incremental discount? 40 minus 10%. 40% minus 10%. 30% is the incremental discount, right? Is it clear to everyone? This 30% is the incremental discount. Is it clear to everyone? Is it clear to everyone? Saina, just hold on. Let me complete this particular query, this particular question, and after that you will be able to understand, right? Clear? So 30% is the additional discount, right, Namita? 30%. Now the question arises, sir, we understood that it is a separate performance obligation. One is sale of goods, of course, and the second one is right of discount, right of future discount, which we have given to the customer, like discount voucher which we have given to the customer. But how to calculate the value of this discount voucher? Should I not recognize the entire 10,000 or 1,000 rupees sales right now? So answer is no, right? So how to evaluate the value of this discount voucher? So the entity believes that there is a 80% likelihood that a customer will redeem the voucher, and on an average, the customer will purchase 500 of additional products. And these all things depending upon the estimation. This is like a variable consideration kind of thing. Okay, so it depends that how many customer will come back and avail this discount, and how many customer, when customer will come back, so they will do the shopping of 1000 rupees or 500 rupees or how much of amount, right? So entity has expectation according to the past precedent. So in this case, it is given that the entity believes there is 80% likelihood that a customer will redeem the voucher, and on an average a customer will purchase 500 of additional products. Determine how many performance obligation does the entity have and their standalone selling price and allocated transaction price. What is the ask of the question? The ask of the question is, first question, how many performance obligation are there? There are two performance obligation: selling goods and services right now and giving a right of additional discount in the future, right? So how many performance obligation? Two performance obligation. And the question is asking about the amount of the performance obligation, standalone selling price of the performance obligation, and allocated transaction price as well. Okay, and allocated transaction price as well. So guys, let me take you again on the Excel file so that I will be able to tell you how this case study will be solved, right? And this case study is, what is the illustration number 23? Illustration 23. So in this particular illustration, first of all, what is the material right of discount? Material right of discount is equal to incremental or additional discount. Incremental discount, which is nothing like, which is 40% minus 10%, which is 30%, right? Which is 30%. Okay. Now, value of discount voucher. How to calculate value of discount voucher? So value of discount voucher will be calculated by expected purchases multiply by likelihood of purchases multiply by material right of discount. So in this particular case, what is my expected purchases? In this particular case, what is my expected purchases which is given in the question? What is my expected purchases which is given in the question? 500 multiply by what is the likelihood of purchases? 80% multiply by what is the material right of discount? 30%. 30%. Is it clear? 500 multiply by 80% multiply by 30%, then it comes out to 500 multiply by 80% multiply by 30%, right? 120. Is it clear to everyone how this 120 has come? Is it clear? So Namita, please try to understand. This 10% is a seasonal discount which entity is giving to everybody, right? Without entering into any contract. But 40% discount is something which the entity is only providing to those customers who have already entered into the contract, right? Who are meeting a threshold of purchases. If the customer is purchasing from me, I am only providing a discount to those customers. For example, a coaching institute. A coaching institute is saying that if you are learning FR from me, if you are taking a FR classes from me, then only I'll give you a 40% discount on the auditing classes, right? But but generally, this institute is providing 10% discount to everyone. Okay, so in this case, when this institute is recognizing a revenue for the FR classes, whether this institute will recognize the entire revenue for the FR classes as a FR classes, or this institute will allocate some transaction price to the material right of discount, which when the students will come and when they will take the auditing classes, so I need to provide him a discount of 40%. but the 10% I used to provide to everyone. So what is the incremental discount? What is the material right of discount? The material right, I mean to say, this customer, how this customer is different from the other customer. This customer is different from the other customer because this customer has already entered into the contract earlier, and this customer has a right for additional discount. When the walk-in student will ask for 10%, this customer will ask for 40%. So what is the additional or incremental discount which this entity has to provide? This entity has to provide 30% additional discount. So for the additional discount, I mean to say for future sales, I have already collected some consideration as of now, right? So why I am giving a discount for future sales? Because this customer has purchased goods worth rupees a particular limit from me as of now. It means for some point of consideration, I have already received from this customer for the future purchases, right? The classic example is car. You are buying a car from a car dealer and you are paying upfront money to the car dealer, right? And the car dealer is saying that, okay, I'm selling you a car and I will also give you three free services in the next 3 years, right? So again, whether I'm saying a discount or let's say I'm saying that it's 100% discount. If some walk-in customer will come to me and they will get the service done from my service center, I will charge 10,000 rupees. But since you are my customer, when you will come to me for the next 3 times, I'll not charge you any money. It means I'm giving you 100% discount. Then please tell me why we are not recognizing 100% sales at the time of sale of goods. Answer is because there are two different performance obligations. One is sale of car and the another one is providing a services. So we need to allocate this 10 lakh rupees into the sale of car and providing of services, right? Which we will provide in future free of cost at 100% discount. So likewise, if an entity is providing or committing a commitment to provide discount on future sales, it means this entity is collecting some consideration relating to future in the current sales only. Okay, so this entity needs to recognize, this entity needs to allocate the current consideration into these two different performance obligations. One is like sale of car and providing a free service. So likewise, sale of current goods and services and discount voucher, which will give them a right to having an additional discount in the future purchases, right? So it is as simple as that. Just remember the concept or example of car and service, right? So in this particular case, what is the standalone selling price? So first of all, performance obligation. Performance obligation. What is my performance obligation? Sale of product A and discount voucher. So what is the standalone selling price? The standalone selling price of these two things. Sale of product A is of course 1,000 rupees. It is given in the question that the company is availing 1,000 rupees. The company is getting 1,000 rupees for sale of product A. And what is the value of the discount voucher? The value of the discount voucher is 120. Okay. Of course, it is depending on the expectation, right? It is 120 rupees. So what is the total? What is the total here? The total is 1120 rupees. The total is 1120 rupees, right? It is 1120 rupees. Now, what is the transaction price? What is the transaction price? Transaction price. The transaction price is 1,000 rupees, right? 1,000 rupees. It is 1,000. Now this 1,000 needs to be allocated into these two parts. 1,000 multiply by 1,000 divide by 1120. Okay. 1,000 multiply by 120 divide by 1120. So this transaction price needs to be allocated into the proportion of the standalone selling prices. Into the proportion of the standalone selling prices, right? Is it clear? Is it clear, guys? 893 and 107. Is it clear? So what is the accounting entry? What is the accounting entry? Cash account debit. Cash account debit 1,000, right? To sale of goods, which is revenue. Sale of product A. Sale of product A, which is revenue, 893. to you can say that to liability relating to future discount. Okay, which is 107. So at the time of current sales, and at the time of future sales, what will happen at the time of future sales? At the time of future sales or oblique the time period of discount expired, either the sales has been happened or discount time period of discount has been expired. In that case, liability relating to future discount will be debited. The liability relating to future discount will be debited, and to sales account, which is a revenue. Okay, what is the amount? So amount is 107. This entry will get nullified. I hope this is clear to everyone, guys. I hope this is clear to everyone. Great, Namita. So guys, doesn't matter it is a 30% discount, 40% discount, or 100% discount. You need to see from the performance obligation perspective, right? Like in the example of car, selling of car and providing free services is a different performance obligation, and revenue needs to be recognized for every performance obligation. Okay, so this 1000 rupees in this particular example, this 1000 rupees is not only received for product A. This 1000 rupees has been received for two aspects: one for product A and one for the future, one for the providing a discount voucher for the future purchases, right? Understood? Are you using Zomato? Are you using Grofers? So if you see these kind of website, Amazon, Grofers, Zomato, Uber, so nowadays what these companies are doing, these companies are saying just take the membership from us. Like Zomato is saying, if you will take a 300 rupees, if you will pay us 300 rupees and you will take a membership for 3 months, so we will give you 20% discount on every purchase, right? So they are selling a discount voucher, right? Kind of, they are selling a discount voucher. So likewise, this entity has also sold a discount voucher. But when the performance obligation will be satisfied, when that customer will purchase that product within a time period which is given by the entity, right? So as of now, this entity is committing to sell two kind of things. One, product A. The second one is discount voucher. The discount voucher in the form of providing an option for material right to avail the discount. Others will get only 10% discount, but you will get 40% discount, right? Understood? Yeah. Sairam, I hope it is clear to you. Sairam, it will not, this provision should not be there, because if you see the definition of revenue, so whatever the discount will be there, discount has to be netted off from the top line. Discount has not to be shown in the cost, right? Otherwise, this revenue will be inflated. Okay, I hope everything is clear. Thota, Utkarsh, great guys. Yeah. So friends, now I'm moving on to my Excel file, and please PowerPoint presentation. So this is the answer which is given in the institute study material. And in the institute study material, this transaction price has been, rounded off to the nearest 10. You can do that, but you need to put this assumption into your answer, right? I have done at a unit level, okay, but the ICAI has done this 890 and 110, this allocation of transaction price to the extent of the nearest 10 rupees, right? You can do that. So whatever your answer would be, both the answers will be correct, right? Yes, Jay. In case of a J, so in case of a series of goods and services which are substantially same and have the same pattern of transfer, In that case, for example, delivery of daily newspaper, electricity supply, right, water supply. In this case, this is a series of distinct goods and services. When I say distinct goods and services, for example, today electricity is there, you can consume the benefit of electricity today. If tomorrow electricity will not come, so of course you will not be able to consume the benefit of electricity tomorrow. If day after tomorrow electricity will come for 6 hours, you can consume the benefit for 6 hours only. So every day it is distinct, it is different. Different means you can have a different consumption, you can have a different benefit. Like everyday newspaper is a different newspaper, right? Every day it was having a different news. So when you read the newspaper day before yesterday, you have read the newspaper of, you know, Russia has attacked on Ukraine, okay, but for newspaper just 5 days back this information was not there. But the standard says that, is it a daily basis of performance obligation? If it is a distinct performance obligation, do I need to recognize revenue every day? Answer is no. Standard says that if there is a series of distinct goods and services, okay, which is having a same nature, substantially same, and having a same pattern of transfer, in that case, the revenue has to be recognized over a period of time. For example, it could be on a monthly basis, it could be on a bi-monthly basis, right? So the measure of progress needs to be measured. Like in case of electricity, in some states or in some jurisdiction or geographies, the electricity bill used to generate it for every 2 months, right? So it should be on a monthly basis, right? So you can say that the performance obligation has to be measured on a monthly basis, right? So let me see if there is any query. Sairam is asking, sir, what is the GST effect on this transaction? Sairam, although I'm not a tax expert, but let me tell you, for the tax authorities, so they will charge the GST on the invoice amount. The invoice is for rupees 1,000, Sairam, right? So if I have purchased 10,000 rupees of product from Louis Philippe outlet, of course, he will raise me an invoice of rupees 10,000, and he will give me a loyalty points, or let's say he will give me a discount voucher, or he will tag my number and he will say that, sir, if you will come to our outlet, just tell me your number and we will put your number and the system will apply 40% discount on all your purchases, right? So GST will be paid for the 10,000 rupees or 1,000 rupees in this particular case. And for example, in the future, when you avail the discount for 5,000 rupees of shopping, 40% discount, so GST will be payable for 3,000 rupees, not on a 5,000 rupees, right? So whatever is the invoice value, GST has to be payable on invoice value. So friends, we have also discussed the concept of warranty. If it is a service type warranty, and this warranty can be purchased separately from the goods or services, the revenue from the warranty is required to be recognized as a separate performance obligation. So we discussed this aspect also. Now we are going to discuss the third aspect, determination of transaction price. Determination of transaction price. What is the meaning of transaction price, right? So friends, we are moving to step 3. Determination of transaction price. Determination of transaction price. What is a transaction price? So far you have understood the meaning of transaction price. So what is meant by transaction price? Guys, what is meant by transaction price? What is meant by transaction price? Tell me. Transaction price. Can I write it as a TP? Transaction price is an amount which the entity expects, why the word expects has been used here. Which the entity expects in exchange of transfer of goods and services to the customer. Goods and services to the customer, right? In exchange of transfer of goods and services to the customers, excluding amount collected on behalf of third parties. Excluding amount collected on behalf of third parties. What is the transaction price? Transaction price is an amount which the entity expects. For example, the contract is for 10 lakh rupees, but the entity only expects that I will be able to receive 6 lakh rupees only, right? So in this case, whether the transaction price for that product is 10 lakh rupees or 6 lakh rupees. Remember, step number 1, identify the contract with the customer. Yeah, is it 10 lakh rupees or 6 lakh rupees? Yeah. Yes, you are right, Utkarsh. It is 6 lakh rupees due to step number 1, right? It is 6 lakh rupees, right? For example, the contract price is rupees 10 lakh, and the expected collection is rupees 6 lakh. I'm assuming that each one of you is writing this particular example or these particular notes is rupees 6 lakh. Yes. So in this case, what is my transaction price? In this case, my TP is equal to 6 lakh. Not. Second example, the contract price is rupees 1000 and 18% GST has also been collected from the customer. So tell me, in this case, whether TP transaction price is 1000 rupees is 1000 or 1118 rupees. What is the transaction price? Tell me, what is the transaction price? What is the transaction price? Namita, what is the transaction price? Yeah. So what is the definition of transaction price? Transaction price is an amount which the entity expects in exchange of transfer goods and services to the customer, excluding amounts collected on behalf of third parties. So this GST, this entity is collecting on behalf of the government. The entity will collect the GST from the customer and deposit the GST into the account of the revenue authorities, account of the GST authorities. So in this case, the transaction price is not 1118. The entity will pass an entry bank account debit 1118 to revenue 1000 to GST payable 118, right? In this case, the transaction price is equal to 1000, okay, not 1118, right? Third example, the contract price is rupees 1 lakh, okay. If the entity will deliver the product before contracted delivery date, okay, the entity will get an incentive of rupees 50,000 okay. So tell me, of rupees 50,000, the entity has a past history. The entity has a past history of delivery before that date and estimate to receive a bonus of rupees 50k of rupees 50,000. What is the TP? What is the transaction price in this case? Yes, friends, tell me what is the transaction price in this case? Yeah. Tell me what is the transaction price in this particular case? The contract price is 1 lakh rupees. Okay. If the entity will deliver the product, so the fixed price is 1 lakh rupees. But if the entity will deliver the product before contracted delivery date, for example, you have entered into a contract with the contractor to construct your house, and the agreement or contract was 1 lakh rupees. But before Diwali, you have to do the housewarming of your new house. So you told your contractor, if you will deliver this house or you will complete the construction of this particular house before Diwali, I'll give you an incentive of rupees 50,000, right? And this entity has a past history. This entity has a past precedent that it has always delivered before time, right? And this entity is expecting that, yes, I'll receive a bonus of rupees 50,000 also. I will receive a variable consideration of rupees 50,000 also, in addition to the fixed consideration of rupees 1 lakh. So what is the transaction price in this particular case? Is it 1 lakh or is it 1.5 lakh? Jay is saying 1,50,000. Namita is saying 1,50,000. Yeah. Utkarsh is saying 1,50,000. Okay. Good that everyone is on the same page. Sairam, in my earlier example, it is not 1,118. 118 is getting collected from the customer on account of GST. It is not on account of revenue. So out of 1,118, 1,000 we will pick in our pocket, we'll keep in our pocket, and 118 we will deposit to the GST authorities, right? We are collecting on their behalf, right? Like TDS. So you are deducting a TDS while doing a payment to a vendor or a contractor, and you are depositing this into the account of the government. So Priya is saying 1.5 lakh, Tanushree is saying 1 lakh. So Tanushree, what is a transaction price? So when I say transaction price is not only a fixed price, it includes fixed price as well as fixed consideration, as well as a variable consideration, right? And what is the definition of transaction price? The definition of transaction price is transaction price is an amount which the entity expects in exchange of transfer of goods and services to the customer, excluding amount collected on behalf of third parties. So what entity expects here? Entity expects a fixed price of 1 lakh and 50,000 rupees of variable consideration, right? So in this case, most of you are right. In this case, transaction price is 1.50 lakhs. Clear? 1.50 lakhs. Clear? We have understood the meaning of transaction price. So transaction price includes fixed consideration as well as variable consideration, right? So what could be the variable consideration? What could be the variable consideration? So the variable consideration could be, when I say variable consideration could be your bonuses, refunds, volume rebate. In example, in case of FMCG business, okay, when you see the FMCG business, for example, there is a Big Bazaar outlet, okay. So Big Bazaar has entered into a contract with PepsiCo, and PepsiCo is saying that if you will buy 10,000 bottles from us, we will provide you these bottles at 10 rupees per bottle. If you buy 20,000 bottles for us, whenever you will cross 10,000 and you will reach to 20,000, we will give you the additional discount, and we will provide you these bottles at 8 rupees. And I'll give you this 8 rupees on this entire 20,000 bottles, right? When you reaches to 30,000 bottles, I'll give you this entire 30,000 bottles at 7 rupees, right? So it means, what is a volume rebate? So PepsiCo is an entity which is recognizing a revenue, okay. So whether PepsiCo will recognize the revenue at 7 rupees, 8 rupees, 10 rupees, what will be the value? So in this case, PepsiCo will consider variable consideration as well. Variable consideration could be positive, could be negative. So PepsiCo will consider, while recognizing a revenue, PepsiCo will consider, today I am selling a goods worth 10,000 unit in this quarter or in this year. Okay. Tomorrow when the Big Bazaar crosses 10,000 units, of course, I need to refund some portion from today's sales as well. For example, when Big Bazaar crosses 10,000 units, this 10 rupees bottle will be 9 rupees bottle, right? It means I have to give Big Bazaar an additional discount of 10%, that is 1 rupees per bottle, when Big Bazaar cross a particular threshold, right? So question arises, my fixed consideration is 10 rupees, I understand. But in case there is a volume rebate, when you buying in a bulk, when you're doing a bulk buying, or when you are buying in a volume, you will get an additional discount. You will get a volume rebate. Okay. So what is that? That is a variable consideration. And standard says that at the inception of the contract, you need to identify whether it is a contract with the customer. You need to determine what are the performance obligation, and you need to determine also what is my transaction price at the inception of the contract. So at the inception of the contract, you need to estimate the variable consideration, whether Big Bazaar will be able to cross the threshold of 10,000 units, or whether the Big Bazaar will not be able to cross the threshold of 10,000 units. And you need to factor this volume rebate or volume discount at the time of inception of the contract. So my dear friends, if you need to see the practical applicability of this particular volume rebates, you can look at the annual report of Nestle. You can look at the annual report of Hindustan Unilever. You can look at the annual report of ITC. These are the FMCG companies, and they are providing the volume rebate to their customers, right? Bonuses. For example, if the goods, or let's say product or service, is meeting a certain quality, right? So we will provide you a bonus of rupees, let's say X amount, right? Incentive payment. If you deliver the goods for a certain quality or before a delivery time, so we will give you incentive as well, right? Penalties. If you will not be able to deliver the goods in time, so we will charge a penalty to you. So what is this? Penalty is a negative variable consideration. So it has to be deducted from the transaction price. Discounts. Just I have taken an example of discount, and if you remember, so we just have done a case study on this particular material right of discount. So if you are providing a material right of discount, of course it is a separate performance obligation, and you need to consider the transaction price. You need to consider the price while allocating the transaction price to the various performance obligation, or while recognizing a revenue, you need to consider the variable consideration relating to the discount also, right? I have told you the discount is a variable consideration. If the customer will not come, of course, you are not giving any discount to that customer if he will not come, right? Price concessions. So price concessions is again a kind of a variable consideration. So variable consideration is very important to determine, very important to identify, because in many contracts there are variable consideration, and this variable consideration needs to be estimated at the time of inception of the contract, right? And the second thing is, while estimating the variable consideration, you need to do your estimation in such a way that the significant revenue reversal will not arise in future. For example, today you have recognized a bonus revenue of 50,000 rupees. Tomorrow you will say that no, I'll not be able to deliver this, and I am reversing this 50,000 rupees. So your estimation should be close to accurate. So it has to be weighted by past precedents. It has to be weighted by the current facts and circumstances. For example, there is an entity, and I'll give you a classic real life practical example. So there is a builder in Noida. Okay. So I'll not take the name of the builder. So in Noida, there is a builder. If you go to book a flat, if you go to that builder and you will book a flat from that builder, so he will say that I will be able to deliver this project in 3 years. And there is a past history of that builder, that this builder always used to deliver before time. he used to take a margin of that time, and he used to work with his own money or with the customer's money. So his no any project is funded from the bank. He is not into the debt. That builder is not a debt laden builder, right? So always he used to deliver before time. He used to take a sufficient margin while entering into a contract with the customer as far as time is concerned. Okay, so that is why, according to the strategies of that builder always used to deliver in time or before time, right? So if a customer will say that, okay, if you will deliver before this time, I will give you 2 lakh rupees extra for this 1 crore rupees of flat, right? So in this case, this variable consideration of 2 lakh rupees is associated with the delivery of the flat, right? So in this case, if the builder expects that, yes, according to the current progress of the construction, okay, according to the past history, according to the experience, I know that I will be able to deliver in the 2 years only, right? Only the small work will going on, but I will be able to deliver in the 2 years time only. And I'm talking about 3 years time right now. Okay. So as far as this particular facts and circumstances are concerned, the builder is highly reasonable in expecting that yes, this variable consideration will be received and I will be able to deliver before time. So my dear friends, 2 things are very important while estimating a variable consideration. First, how to estimate a variable consideration, and while estimating a variable consideration, you need to be doubly sure that this reversal will not occur in future. Sir, what happens if the reversal will not occur in future? So nothing will happen, but of course it will tantamount to a recording of an artificial revenue if you will not do your work properly, if it is not guided by the facts and circumstances. So as an auditor of the company, for example, if you are going to audit a FMCG company or a company where variable considerations are there, you need to ask for the relevant documents. So you need to ask for the relevant assumptions and past trends, okay, that why the company is also considering the variable consideration of X amount while determining the transaction price, right? Understood? Is it clear to everyone, guys? Yes, Namita, I'll upload the Excel sheets of earlier 2 classes also. This is a single Excel sheet where I am putting all these examples and all these things, okay? So I'll share this Excel sheet once these 5 classes will get over, right? So friends, as far as this transaction price is concerned, we understood that transaction price is a fixed transaction price as well as a variable consideration. Transaction price is something which is the amount of consideration which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amounts collected on behalf of third parties, right, like GST, right? So now coming to the Excel file. So as far as transaction price is concerned, we'll talk about the 4 aspects of transaction price. Okay, we'll talk about the 4 aspects of transaction price. One, of course, we are going to talk about variable consideration. Second, we are going to talk about significant financing component, right? Third, we are going to talk about consideration, non-cash consideration. Fourth, we are going to talk about consideration payable to a customer. Okay. So these are the 4 aspects which we are going to cover today as far as these 4 items are concerned. Variable consideration, significant financing component, okay, non-cash consideration, and consideration payable to customer. Let me take you through with all these aspects one by one. So first of all, let's talk about the variable consideration, right? Variable consideration. What is meant by variable consideration? So far we have understood. So variable consideration means the consideration which is dependent on the future event or future outcome. For example, if this vendor or a contractor will be able to deliver the goods in future before time, then only he will be eligible to that particular discount. So variable consideration means a consideration which is dependent on the future outcome, right? Future event or future event. So estimation, while estimating the variable consideration, all the constraints needs to be considered. What is meant by constraints? All the limitations, all the problems, all the obstacles, okay? Everything needs to be considered while estimating the variable consideration. All the constraints needs to be considered, right? Now, how to estimate the variable consideration? How to estimate the variable consideration? How to estimate the variable? How can I estimate that yes, I will be able to receive 50,000 rupees in addition to 1 lakh rupees? So of course, it will be depending on some probability, right? So we need to use the statistical approach. We use the statistical approach, right? So it is depending on the probability, and the standard gives you two aspects. Okay, one is expected value approach, and the second one is most likely approach. For example, we are saying that if the contractor will be able to deliver this project 3 months early, then he will be eligible for a incentive of 50,000 rupees. If he will be able to deliver this project 2 months early, he will be eligible for a incentive payment or bonus of let's say 40,000 rupees. If he will be able to deliver 1 month early, he will be eligible for a bonus of let's say 20,000 rupees. If he will be able to deliver this project 15 days early, he will be eligible for an incentive of 10,000 rupees, right? So these are the things. So if you see this particular example, there is a multiple outcome. There is a multiple outcome of a particular event. Right? There is a multiple outcome of a single event. Okay. In this, if there is a multiple outcome of a single event, in that case expected value approach is important and it is applicable. What is the expected value approach? This expected value approach is also known as a probability weighted approach. Guys, don't worry, I'll take a lot of example. Probability weighted approach. Okay. And of course, it is not a new thing. We have also learned this aspect in Ind AS 36 impairment of assets and in various standards. Okay. What is the most likely approach? So most likely approach means either this will happen or this will not happen. Example, if the customer will say that if you will deliver early, I'll give you a bonus. If you will not deliver early, I'll not give you a bonus. Okay. There is no benchmark of 3, 2, 1, 15 days. Okay. Either it is yes or it is no. If there is a binary outcome, yes or no, in that case, most likely approach is required to be used while estimating and calculating the variable consideration, right? So friends, let's do some case study on this particular aspect, and okay, and then we will be able to understand this thing in detail, right? So we understood what is a transaction price, and we understood that it includes fixed consideration as well as variable consideration, and we understood that transaction price is affected due to the 4 factors. One is of course a variable consideration. Second one is there could be a significant financing component, there could be a non-cash consideration, and there could be something where the consideration is paid or payable to a customer. Generally, customer pays the consideration to the entity, but if the entity is paying a consideration to the customer, then how this accounting has to be happened, right? So expected value and most likely amount we have discussed. So this either of the approach is required to be used which is more appropriate for a particular transaction. Let's understand with the help of this particular example. Entity enters into a contract and will receive a 1 lakh rupees of performance bonus if specified performance targets are met, right? Of course, if it is depending on something which will happen in future, it is a variable consideration. Entity estimate 80% likelihood it will receive entire performance bonus. So there are 80% chances that performance bonus will be received, and 20% chances that there will not be any bonus, right? There will not be any bonus. So if you see, either it will be there or it will not be there. The multiple outcome has not been given. The multiple outcome has not been given that yes, there are 40% chances that the entity will receive 80,000 rupees. There are 50% chances that the entity will receive 60,000 rupees. Okay. So that is not there. Only a single outcome is there. Only a single outcome is there, right? So 80% chance that the entity will receive a bonus, 20% chance entity will not receive a bonus. So in this particular case, what is the most appropriate method? Is it an expected value method or is it a most likely method? What is the most appropriate method, guys? Guys, I know this is a very lengthy standard, and that is why there are a lot of examples and practical case studies which is there in this particular standard. And if you see the institute study material as well, so in ICAI study material, there are a lot of case studies, lot of practical examples which is there in the study material. And when you read those examples and case studies along with the explanation, you will be able to understand the concept as well, right? And even in my sessions, I have given my examples as well as I'm taking ICAI examples as well as I'm taking real life examples so that you will be able to understand that what is the objective or how this application will happen for these aspects of Ind AS 115, right? So in this particular case, outcome is not multiple, it is binary. It is a binary outcome. And when there is a binary outcome, the most likely approach is required to be used. Due to the binary nature of outcome, entity determines that the best predictor of the ultimate consideration it will receive is the most likely approach. So 80%, more than 50% that yes, it will happen. Okay. So therefore 1 lakh rupees is included in the transaction price, right? Second example, entity enters into a contract and it will receive a performance bonus up to INR 10 lakh, up to INR 1 lakh if it meet specified performance targets. It estimates the likelihood of achieving the targets as what are the possible outcomes? So it will receive 1 lakh rupees and the probability is 10%. For receiving 1 lakh rupees bonus, that probability is 10%. So what is the probability weighted amount? So outcome is A, probability is outcome is A, probability is B, and what is A multiplied by B? What is the probability weighted amount? It is 10. For receiving 80,000 rupees, the probability is 30%. So what is the probability weighted amount? 24,000. For having 60,000 rupees, probability is 35%. What is 60 multiplied 35%? 21,000. For having 40,000 rupees, probability is 10%. So this is 4,000. For having 15%, for having zero outcome, the probability is 15%. So what is the calculated amount? It is 0. So what is my total? What is my total consideration? It is 59,000. It is 59,000, the total consideration. So in this particular case, which method is more appropriate? Expected value method is more appropriate or most likely method is more appropriate? In this particular example, whether multiple outcome of a single event is given or a binary outcome of a single event is given. Is it written in like the last example that yes, 1 lakh rupees will be either received or not received? In this example, there are a lot of probability. 10% chance of 1 lakh rupees, 30% 80,000, 35 60,000, 10% 40 and 15% nothing. So since in this particular example there are multiple outcome of a single event and hence probability weighted approach is the most likely approach, probability weighted approach is the most suitable approach which is required to be used while estimating the variable consideration, right? So expected value approach, which is a probability weighted approach, is determined to be the best method. Entity calculate 59,000 using this particular method. An entity needs to be determine all the constraints, I mean to say all the limitations, while estimating the variable consideration, so that once entity will recognize this amount, the significant reversal will not happen, right? I hope it is clear to everyone. Yeah. So in that example, Namita, for that builder, of course, probability weighted approach, expected value approach is the most appropriate approach, right? That what is the probability that this project will be able to deliver 3 months early? What is the probability for 2 months early? What is the probability for 1 month early? What is the probability for 15 days early? And what is the probability that it will not deliver early, right? Right. Third example. Entity enters into a contract and will receive a performance bonus based on 5 potential amounts if specified targets are met. It estimates the likelihood of achieving the target as follows. Currency unit, CU is currency unit, INR, okay? So 1 lakh, 15% probability, 80,000, 30%, 60,000, 30%, 40,000, 10%, nothing, 15%. So this is the probability weighted approach. And since there are multiple outcome of a single event, so which is the best method? Expected value approach is the best, right? Same example like example number 2. Yes, very important. Example number 4. Company A supplies component to industrial customers, right? The contract stipulates that the price per component will decrease as the sales volume increases within the stipulated period of time. The price applicable for the entire sale will be based on the sales volume bucket, right? So the price per unit will be 100 rupees if the sales volume will be 0 to 10 lakh units. The price will drop to 90 rupees if the sales volume will be 10 lakh to 30 lakh units. And the price will again drop to 85 rupees if the sales volume will be more than 30 lakh units. So this is an example of volume rebates. Okay. When you will buy at a high volume, you will get a more discount and rebates, right? So this is a variable consideration. So in this case, you need to estimate the variable consideration, right? You need to estimate the variable consideration. So how is revenue estimated under Ind AS 115, right? So first of all, A estimates. Now I'm solving this question by both the approaches, right? So you have understood the facts that the entity is selling this product, like PepsiCo is selling this product to Big Bazaar, and PepsiCo is saying I'll charge 100 rupees per bottle if the sales volume is up to 10 lakh unit. I'll charge 90 if it crosses 10 lakh, and up to 30 lakh I'll charge 85 if it crosses 30 lakh units, right? A estimates probability weighted variable consideration based on the range of possible outcomes and probability of each outcome, right? All possible outcomes are required to be assessed and quantified. For example, there is a probability of 10% that the entity will be able to sell only 8 lakh units. Big Bazaar will be able to purchase only 8 lakh units. So what is the price per unit in this bucket? 100 rupees. And what is the probability weighted sales value? 8 lakh multiplied by 100. 8 lakh units multiplied by 100 multiplied by 10%. A is the probability, B is the volume, C is the price. And the probability weighted sales value is A multiplied by B multiplied by C, right? So what is my probability weighted sales? My probability weighted sales is 8 lakh multiplied by 10%, 80,000 units. What is my probability weighted sales price? 80,000 multiplied by 100, 80 lakhs, okay? There is a 70% chances that the entity will be able to sell 25 lakh units. So 10 lakh to 30 lakh, the price is 90 rupees. So what is my probability weighted sales volume? So 25 lakh multiplied by 70%, 17.5 lakh. And 17.5 lakh multiplied by 90 will comes out to 15 crore 75 lakhs, right? There are 20% chances that the entity will be able to sell 35 lakh units. And when the entity will cross 30 lakh, the price is 85 rupees. So what is my probability weighted sales volume? 35 lakh multiplied by 20%, which is 7 lakh. And 7 lakh multiplied by 85 is 5 crore 95 lakh. So the total is 100%, and the total probability weighted sales volume is 25,30,000. So going by all the possible outcomes, the entity determines that I will be able to sell 25,30,000 at the time of inception of the contract. And if I will be able to sell 25,30,000, my probability weighted sales value will be 22 crore 50 lakh. 22 crores 50 lakh. Then what will be my average? What will be my average sale price? So average unit price will be 22 crore 50 lakh divided by 25 lakh 30,000, which is 88.93. So revenue is recognized at 88.93 for each unit sold. For the first 10 lakh units sold, liability is accrued at 11.07. So in this particular case, if the entity is selling 10 lakh units, so of course entity is getting a consideration for 10 lakh multiplied by 100. So in this case, cash account will be debited by 10 lakh multiplied by 100. Revenue will be recognized by 10 lakh multiplied by 88.93. To liability, customer's liability will be recognized with 10 lakh multiplied by 11.07. Right? So this is the expected value approach. By this, this is the expected value approach, and by this way, the variable consideration needs to be determined and the revenue needs to be recognized, right? So although for the first 10 lakh unit, the entity is getting 10 rupees, 100 rupees per unit, but entity will recognize a revenue of 88.93 and 11.07 of liability, right? When the entity will sold the additional units, the entity will get the consideration of 90 rupees, but the entity will get the entity will recognize the revenue at 88.93, right? Is it clear? Is it clear, guys? I hope it is clear to everyone. And this amount will be reversed upon the subsequent sales, right? Yeah. Now coming to the most likely approach. What is the most likely approach? For example, the entity believes that the total sales volume for the year will be 25 lakh units only. It will be 25 lakh. They will not be able to sell more than 25 lakh units, right? So in this case, what is the most likely approach? Going by the most likely approach, they are saying that we will be able to 25 lakh units. So what is the price for 25 lakh unit? Where it will come? It will come in the bucket of 10 to 30 lakh. It will come into the bucket of 10 to 30 lakh. In this case, based on the most likely method, the transaction price is calculated as follows: 90 per unit multiplied by 25 lakh, 22 crore 50 lakh rupees, right? So what is the average unit price? Average unit price is 90 rupees. Clear? Simple. Because this is the most likely approach and multiple outcomes are not there. We are not going by the probability weighted approach. We are only going by the what is the applicable price into this quantity range. So it is 90 rupees. Okay. So in this case, for the first 10 lakh units sold, liability is accrued at 10 rupees. Consideration received at 100, but the liability is accrued at 10 rupees, right? And it will get reversed upon the subsequent sales. Clear? Is it clear to everyone? Is it clear to everyone, guys? Clear? Yes or no? Yes or no? So friends, now you are, so some of the participants are asking, Namita is asking, sir, for example, if there is a 27 lakh unit, what will happen with 11.07? Okay, so let me make you guys understood with the help of the journal entries, right? So what will the journal entries? Journal entries in the case of expected value approach for expected value approach for volume rebate, right? For example, for first 10 lakh units, what is the entry? The entry is bank account debit, and it should be for 10 lakh 1, 2, 3, 4, 5 multiply by 100, right? So 10 lakh multiply by 100. 10 lakh unit multiply by 100, right? To revenue or sales account, to revenue. Okay. And this should be for 10 lakh unit multiply by 88.93. So 10 lakh multiply by 88.93. To deferred revenue or deferred liability, let's say to deferred liability. To deferred customer liability, we can say that deferred customer liability, right? Because I need to refund that, I need to adjust that. And what is that? To customer liability. So let me put in this way, in the manner of entry, say this minus this. Okay. So how many items are there? 25 lakh 30,000. For example, there is 25 lakh 30,000 units which is able to be sold, or let's say the total units are let's say 30 lakh units, right? So example, total units sold is like 25 lakh units. 25 lakh. So the next 15 lakh units. For the next 15 lakh units, what will happen? So first of all, in this particular case, the next 15 lakh units, how much money you are required to receive? So bank account debit, again, bank account debit, 15 lakh multiply by 90, because when it will cross the threshold of 10 lakh unit, the total amount will be at 90 rupees. So I'll do the adjustment later on. First of all, let me show you the separate part. So bank account debit, 15 lakh multiply by 90 to revenue account. So bank account will be debited by 15 lakh multiply by 90, because the applicable threshold is 90, but it is for the entire, right? To revenue, so to revenue is how much? 15 lakh multiply by, it is 15 lakh multiply by 88.93, because this has to be recognized at 88.93. This is my this price. Okay. To deferred customer liability, right? To deferred customer liability, 135 minus this one, 16 lakh 5,000. Now friends, now what we have done, for the next first lakh, we have taken a money from the customer at the rate of 100. For the next 15 lakh units, we have taken a money from the customer, 15 lakh multiplied by 90 rupees. Okay. So this could be the case, or customer will say that, boss, I have crossed 10 lakh unit of threshold. So now I need to pay you 25 lakh multiplied by 90 minus whatever I paid you earlier, right? So that would be the case. So first of all, total value applicable to 25 lakh units. 25 lakh units. The total value applicable to 25 lakh units. 25 lakh 1, 2, 3, 4, 5 multiply by 90, right? So because it is getting into a threshold of 10 lakh to 30 lakh. So what is the total value? What is the total value which is applicable here? It is 25 lakh multiplied by 90. So 90 is the total value. So 25 lakh multiplied by 90. So this will be the applicable price. Okay. 25 lakh multiplied by 90. So what is the consideration actually received? What is the consideration actually received? Consideration actually received. How much consideration is actually received? So this plus this, 23 crore 50 lakh. So what is the actual refund which is needs to be given to the customer? What is the actual refund which needs to be given to the customer? 1 crore rupees. 1 crore rupees is required to be given to the customer. Okay. And in this particular case, since we have stopped at 25 lakh unit, so the applicable price is not 88.93. The applicable price becomes 90. Okay. If we would have crossed to 30 lakh unit, probably the price will gone down to even 90, because it will be 85 for more than 30 lakh units. But as of now, if this volume rebate is for a particular year, and in this particular year the entity is able to sold only 25 lakh units, so the applicable price will be 90. So in this case, deferred customer liability will get debited. So what will be the next entry? Next entry will be deferred customer liability debit. And how much is the deferred customer liability? So you have to settle this account now. So this liability will get debited. And what is the deferred customer liability? 16 lakh 5,000 plus 1 crore 10 lakh 7,000, right? Two, cash account. Cash account, let's say you have to refund to the customer. To cash account, you need to refund to the customer, right? So refund to the customer, or it will be adjusted from the next sales. Okay, whatever it could be, but it would be like refund to the customer. Two, to revenue. And if you will see, what is this 26 lakh 75,000? It is a difference between how much units are there? 25 lakh units multiply by 90 minus 88.93, right? 98 minus 88.93. So 25 lakh 1 2 3 4 5 multiply by 90 minus 88.93. So this is 26 lakh 75,000, right? 26 lakh 75,000. So this will be the accounting entry, right? This will be the accounting entry. So the net revenue has to be recognized for 25 lakh units at a price of 90 rupees, right? So initially, when the company has purchased, company has sold 10 lakh unit, company has recognized a revenue of 88.93, which is probability weighted average price. But when the situation progresses, the company will have more visibility. And when the company closes the financial year, the company said that, okay, so this volume rebate was applicable for a financial year. And in the financial year, in the last quarter, this customer is able to achieve only 25 lakh unit of target. So this customer will be given a discount of 10 rupees only, and the applicable price is 90 rupees only. And hence in the next year, what we will do, we will refund the money as per 90 rupees, and we will recognize the revenue as per 90 rupees, right? So in the next quarter, or when at the time of 15 lakh unit, this settlement will happen, and this revenue will be recognized at 13 crore 33 lakh 95,000 plus 26 lakh 75,000. Okay, and this 1 crore should be refund. Or even there could be a case where customer will deduct 1 crore rupees, and customer will not pay you 13 crore 50 lakh, customer will pay you 12 crore 50 lakh. So whatever it could be, but net implication you can understand with the help of these three case studies, right? With the help of these three journal entries, right? I hope this is clear to everyone, guys. I hope this is clear to everyone. Namita, is it clear? Okay. Is it clear? Utkarsh, Shruti, is it clear to everyone? So guys, let me tell you, although the standard is very lengthy, little complex as well, but the practical, as far as the practical examples are concerned, you will enjoy this particular standard, right? I hope it is clear to everyone, guys. Namita is saying yes, sir, it is crystal clear. Thanks, Namita. Utkarsh is saying yes, sir. Shruti is also saying it's absolutely perfect. Great, Shruti. So guys, it's 8:45. Let's have a 15 minutes break, and we will start at 9. And today's class will run till 10:15 or 10:20, right? Let's have a 15 minutes break, and we will start at 9 o'clock. the break, and I hope my voice is audible and my screen is also visible. So we have just discussed 3-4 examples of variable consideration and how to determine the variable consideration by expected value approach and the most likely approach. Let's do this particular case study from the Institute study material. Illustration number 29. XYZ Limited enters into a contract with a customer to build a sophisticated machinery. The promise to transfer the asset is a performance obligation that is satisfied over a period of time, right? The promised consideration is 2.5 crores, but that amount will be reduced or increased depending on the timing of completion of the asset. So the fixed consideration is 2.5 crores. If I talk about fixed consideration, so fixed price or fixed consideration is 2.5 crore. This will go up or this will go down. It is depending on the timing of completion of the asset, right? It means some variability is there. Specifically for each day after 31st March 2021 that the asset is incomplete, the promised consideration is reduced by rupees 1 lakh. Okay. So if the company will delay or this XYZ, this contractor will delay. So in case of a delay of every day, the penalty, there is a penalty of rupees 1 lakh for a day, right? For example, if the contractor will deliver this machinery by 5th of April, so there will be a penalty for 4 days or 5 days, right? But if the contractor will deliver the goods early, deliver this machine before time. So for each day before 31st March 21 that the asset is complete, the promised consideration increased by rupees 1 lakh. So if it will be early delivery, so for every day 1 lakh rupees incentive is there. For every 1 day delay, there will be a penalty of rupees 1 lakh. So there is a variable consideration either by way of penalty or by way of incentive. In addition, so fixed price is 2.5 crore. Variable consideration in terms of incentive or penalty is 1 lakh rupees each day. So if it is early, 1 lakh rupees incentive. If it is delay, 1 lakh rupees penalty. In addition, upon completion of the asset, a third party will inspect the asset and assign a rating based on metrics that are defined in the contract. So in addition, upon completion of the asset, when the asset will complete, the third party will inspect the asset and the third party will assign a rating for the quality of that particular machinery. If the asset receives a specified rating, the entity will be entitled to an incentive bonus of rupees 15 lakh, right? So in addition of this incentive or in addition of this bonus or penalty for a day early or day delay, so there is an incentive bonus of 15 lakh rupees as well, right? So determine the transaction price. We need to determine the transaction price. Now, the fixed consideration is 2.5 crores. And there are two variable consideration in this particular case. The one variable consideration is for every day early, it will be a 1 lakh rupees of bonus. And for every 1 day delay, there will be a penalty of rupees 1 lakh. Okay. So there could be a multiple outcome of this particular variable consideration. For example, what happens if there is a 1 day early? If what happens if 2 days early, 3 days early, 4 days early? What are the chances that the goods will be delivered 5 days early? Okay. What are the chances that the goods will be delivered by 1 day delay, 2 day delay, 3 day, 4 day, 5 day, 6 day delays, right? So there is a penalty as well as there is an incentive for early delivery as well as delay in delivery, and there are multiple outcome of this particular event, right? And hence in this particular case, what is the most appropriate method? The most appropriate method is expected value method. But when we talk about the second incentive bonus, which is depending on the rating, if the company got a specified rating, this 15 lakh rupees will be received. If the company will not get that rating, this 15 lakh will not be given to the company, to the contractor, right? So in this case, what is the most appropriate method? The most likely approach is the most suitable method. most likely approach is the most suitable method, right? When determining the transaction price, the entity prepares a separate estimate for each element of variable consideration to which the entity will be entitled using the estimation method described in para 53 of Ind AS 115. Sir, whether in the exam we used to write this para number, answer is no. You are not required to write this para number. You are just required to write the things like the entity is required to do the best estimation as per expected value approach or most likely approach, right? So I have told you in the first case, expected value method is the most appropriate approach, and in the second case, most likely amount is the most appropriate approach. Illustration number 30. AST Limited enters into a contract with a customer to build a manufacturing facility, right? The entity determines that the contract contains one performance obligation satisfied over a period of time. So there is only a single performance obligation. Construction is scheduled to be completed by the end of the 36th month for an agreed upon price of rupees 25 crores. Construction is scheduled to be completed by the end of the 36th month for an agreed upon price of rupees 25 crores. So what is the fixed consideration? 25 crores. And what is that agreed or contracted time period? It is 36 months, right? So this is the agreed time period of 36 months, and the contracted price is 25 crore, which is a fixed consideration, right? Clear? Now some variability is given in this question. The entity has the opportunity to earn a performance bonus for early completion as follows. So if the company will deliver these goods early, okay, this construction will completed early, so the entity will have some performance bonus. 15% bonus, 15% bonus of the contract price if completed by 30th month, 25% likelihood, right? So the company will get 15% bonus of 25 crore if the project will get completed by 30th month. And what is the probability? It is 25%. 10% bonus will be paid to the company, to the contractor by the customer if it will be completed by 32nd month, and the chances of happening or to get completed by 32nd month is 40% chances. There are 15% chances that this project will get completed by 34th month, and the bonus will be 5%, okay, of 25 crore, right? In addition, so 25 plus 15, 40, and 40, 80, and there are 20% chances that this will not happen, right? It means the company will not be able to deliver before 36 months, right? In addition to the potential performance bonus for early completion. So this is one variable consideration. And there is another variable consideration also. In addition to the potential performance bonus for early completion, AST Limited is entitled to a quality bonus. Apart from the performance bonus, it is also entitled for a quality bonus of rupees 2 crore if a health and safety inspector assign the facility a gold star rating as defined by the agency in the terms of the contract, right? So as far as this variable consideration is concerned, there are multiple outcomes of this particular performance bonus event. And in this particular scenario, what is the best method? Expected value is the most appropriate method. And apart from this potential performance bonus, for this quality bonus, what is the most appropriate method? For the quality bonus, the most appropriate method is most likely approach, most likely method, okay? So AST Limited concludes that it is 60% likely that it will receive the quality bonus, okay? So there are 60% chances, means more than 50% chances are there that it will receive a bonus. Determine the transaction price. So guys, I hope you are clear on this. Students, I hope it is clear to all of you. Let me know if you have any doubts so far. So in this particular case, of course, I'm not reading this entire, this entire theory which is given. You can read that theory. I have explained this thing. And for this kind of performance bonus, probability weighted average is required. And there are 15% chances. So what is the amount of bonus? 25 crore multiplied by 15%. comes out at 3.75. And for this 3.75, the probability is 25%, which comes out at 0.9375. So on and so forth, that the probability weighted average total is 2.125. So what is the amount of variable consideration relating to performance bonus? It is 2.125 relating to the performance bonus. So what is my transaction price? My transaction price is 25 crores, which is my fixed consideration, plus performance bonus of variable consideration comes out to 2.125. Okay. And what is for quality bonus? For quality bonus, most likely approach is required to be used. And what is most likely? So chances of happening for more than 50%. So 60% chances is there that the company will able to receive 2 crore rupees of bonus. So quality bonus will be 2 crore rupees, right? So what is the total? 25 plus 2 plus 2, 29.125 is my transaction price. And these two items are variable consideration. The first one, 25, is fixed consideration. I hope it is clear to everyone. I'll take a 15 seconds pause and I'll wait for your answer. Utkarsh is saying, yes, sir. This variable consideration part is completely clear. Great, Utkarsh. Shruti is also saying, yes, sir. What about you, Namita, Jay, Thota, Tanushri, Priya? Yes. So guys, now coming to the next part, variable consideration with respect to right of return. So guys, when you listen or when you watch this part 2 of Ind AS 115, at the time of performance obligation, I have told you when there is a right of return. Okay. For example, you are selling 10 quantity and there is a chances of 10% return because you are providing an option, like Amazon is providing a option of return. Okay. Within 15 days, within 30 days. So if there is a right of return, it is not a separate performance obligation. In case of a right of return, so to the extent of return, the revenue should not be recognized, and right to recover asset and refund liability is required to be recognized. So we have already covered this aspect in part 2 of this particular Ind AS 115 lecture, right? I'm not covering it again. I have already covered this. Now coming to the most important part, which is determination of the transaction price, right? So friends, what is meant by significant financing component? What is meant by significant financing component? So J is asking, sir, we will not calculate 2 crore multiply by 60%. J, I have told you, if there are multiple outcome of a single event, like in case of a performance bonus, there were multiple outcome, right? So that is why we have used the expected value approach. And how to use the expected value approach? Expected value approach is nothing. It's a probability weighted approach. So you have to put the chance, which is probability, multiply by the amount, okay, which you are expected to receive, okay, as an entity, as a vendor or supplier. So aggregating it to the 100% level, it will give you the expected value amount, right? But when there are, let's say, binary outcome, I mean to say this will happen or this will not happen. Okay. For example, you are saying that yes, yes, there are 70% chances that I will crack this exam, and there are 30% chances probably I might not be able to crack this exam, right? So you are not saying there are multiple outcomes. You are saying more than 50% chances is there I'll crack this exam. It means most likely approach is going by the most likely approach. Most likely I will be able to crack this exam. Okay. And less likely, I mean to say less than 50%, I will not be able to crack this exam. So my dear students, in this case, it is a binary outcome. And in case of a binary outcome, you are not doing this probability weighted approach. Okay. Because this probability weighted approach has to be used when there are multiple outcomes. So if 50% chances, if more than 50% chances are there that yes, it will receive a star rating. Okay. In that case, we will say that yes, we have to recognize a complete performance quality bonus as a variable consideration. And if less than 50% chances are there, the company will not be able to receive the bonus. In that case, the company will not record that variable consideration at the time of recording the transaction price, right? Or estimating the transaction price, right? Jay, you need to understand what is multiple and what is binary, right? If there are multiple outcome, you need to apply this multiply formula. If it is not a multiple outcome, you need to see more than 50%, less than 50%. Coming to the significant financing component. What is meant by significant financing component? You must have heard that and you must have seen that. You went to a shopkeeper to buy a washing machine, right? You have asked the shopkeeper what is the price. The shopkeeper has told you that the price is, let's say, 10,000 rupees. Then you told shopkeeper, or let's say Chroma outlet, that I don't have 10,000 rupees right away in my pocket. I want to get this, get these things into the EMI, or let's say I will be able to pay after 2 years. So then Chroma outlet will say you, okay, in that case, the price is not 10,000, the price is 12,000. So friends, now coming to this particular example, what will be the revenue for the Chroma? Is it 10,000 or is it 12,000? You all have understood the meaning of revenue. Revenue means revenue from operation, right? So tell me, as far as revenue is concerned, as far as transaction price is concerned, what is the transaction price in this particular case for Chroma? Is it 10,000 or is it 12,000? Is it 10,000 or is it 12,000? Jay, is it 10,000 or 12,000? Yes, it is 10,000. It is not 12,000. It is 10,000. Why? Sir, if this Chroma outlet is selling the goods right away in the outright sale to a customer, the price which it is charging to the customer is not 12,000. It is 10,000. So why this Chroma outlet or this vendor is charging 2,000 rupees extra? Just to compensate the time value of money, right? Because this vendor is selling the goods on credit basis, and of course there is a time value of money. There is a financing component which comes into the play into this particular transaction, and hence this 2,000 rupees has to be recognized as an interest income. So bank account debit 12,000, to revenue from sale of washing machine 10,000, to interest income as an other income 2,000, right? So there is a financing component which is involved in this particular transaction. So first of all, revenue has to be recognized. Revenue has to be recognized on the basis of the price adjusted with the time value of money. Okay, the price which is adjusted for the time value of money, or the price which is adjusted excluding the significant financing component. Sir, for example, the significant financing component is not there. Okay, and the company is charging the money either in advance from the customer, or the company or the customer is giving the goods, customer is paying on a delay basis. For example, there is a high profile customer of a particular company. Okay, for example, there is a Chroma outlet, and a high profile or a loyal customer come to the Chroma outlet, and the customer says, I want this washing machine. Okay, so what is the price? So the vendor or the shopkeeper says it is 10,000, and the customer said that I need this money right away because I have to gift it to one of my relative, and I don't have money in my pocket right now, and I'll pay you after 1 year because I'm traveling to USA and probably I'll come to India after 7-8 months, right? Is it okay if I'll pay you later on? And he is a very loyal customer and he is a very old customer. Okay, so Chroma is saying, okay, don't worry, you can pay after 1 year, right? So the sale consideration, or let's say the transaction price in case of outright sale, was 10,000 rupees, and Chroma is also charging 10,000 rupees from this customer or this vendor even after 1 month, even after 1 year. So in this particular case, there is no any significant financing component which is involved in this particular transaction. And even though if the customer will pay after 1 year this 10,000 rupees, even though the revenue has to be recognized at the time of transfer of control of goods at 10,000 rupees, and this present value is not required. You cannot say that, okay, 10% is my discount rate, for example, 10% is a market interest rate, and the customer will pay after 1 year. So I will discount this 10,000 as of now So I'll calculate the present value of this 10,000 rupees, and I'll recognize revenue at the present value of 10,000. So this will not happen. So friends, if there is a time value of money and if there is an involvement of significant financing component, only then you are required to exclude the significant financing component from the calculation of transaction price. And the significant financing component comes into both the ways. For example, the customer is paying you advance, right? So you will deliver the goods after 1 year or after 2 years, and the customer is paying you advance right away. Okay. So for example, if the customer will pay you after 2 years, it would be, let's say, 100 rupees. But the customer is paying you in advance just 2 years before. The customer is paying you 90 rupees. It means there is a kind of a financing element. Your sale is funded by the customer, right? So customer is funding your operation. Customer is paying you 90 rupees right away to give you 2 years time to deliver the goods after 2 years, right? It means this is something where significant financing component is there, and whether you are required to recognize a revenue of 90 rupees or 100 rupees. In this case, the revenue is required to be recognized for 100 rupees, and the difference between 90 and 100 has to be recognized as an interest cost. Okay, because here the funding is done by the customer, right? Customer is paying you in advance. But if the funding is done by the supplier is giving a credit period to the customer. In that case, the difference in the transaction price and or an amount which is relating to the financing component has to be shown as a interest income, right? Understood? Now let me take you through the Excel file to give you this concept more in detail. Okay, significant financing component. So we have covered the first part. Now we are moving to the second part, significant financing component, right? Significant financing component. First of all, what is a significant financing component? It is a time value of money. It is a time value of money. So the finance component, that is interest income or cost, is difference between the price of the goods and services transferred and the actual consideration received, Okay, and the actual consideration received. So there is a requirement to estimate the significant financing component or interest income and interest component if there is a time value of money, if there is a difference between the time of consideration received and transfer of control of goods and services for more than 1 year, only then it is required to calculate the finance component. Okay, it is required to calculate the finance component. And so it is the difference between the price of the goods and services transferred and the actual consideration received. Or you can say that it is the difference between the cash selling price and the amount actually received. Okay, cash selling price and the amount actually received. Okay, and in this case, what will be the interest rate? In case of significant financing component, the interest rate should be at a market rate of interest. Okay, at a market rate of interest. For example, what should be the implicit rate of interest if I am getting a money of, let's say, so today I'm selling a goods to a customer and I'm charging 100 rupees from that customer, right? Today, if the customer will say me that, boss, I'll pay you after 1 year, okay, So I'll charge 110 rupees, assuming that 10% is the market rate of interest and 10% is my implicit rate of interest, right? So I have to charge 10 rupees of interest with that customer, and I'll charge 110 rupees if he'll pay me after 1 year. If he will pay me after 2 years, I'll charge 110, and again, going by the compounded interest, 10% for the second year. So 110 plus 11, 121. So if he'll pay me after 2 years, I'll charge 121 rupees from that particular customer, right? Is it clear? 121 from that particular customer, so that my cash selling price of 100 rupees will come into the picture, right? Okay, clear? Is it clear? For example, after 2 years, what will be my net present value? What will be my present value factor? If my discount rate is 10%, so 1 divided by 1.1 divide by 1.1, right? This is my present value factor. And let's say I'll receive 121 after 2 years. So what is my present value? My present value is 100 rupees, right? My cash selling price is 100 rupees. This is my cash selling price. Okay, this is my consideration. Okay, the difference between the consideration and cash selling price is interest. It is my interest cost, interest income, right? Is it clear? So friends, now I'll quickly show you one example, and then we will move to the institute study material, right? Case studies on institute study material. Let me know if you have any query so far. Let me know if you have any query so far. The company, let's say the company has sold goods for rupees 10,000, right? So let's take an example so that you will be able to better understand this thing. The company has sold goods for rupees 10,000, right? So there is the goods, and what is the value of the goods? The value of the goods is 10,000, right? And there are three different customers. So customer A, B, and C. A, B, and C, right? Let's put the word revenue here, and let's put the word interest income and interest cost. Interest income, interest cost. Right, friends? From customer A, the customer A is paying upfront. Customer A is neither paying in advance, nor the customer A is doing any delay. Customer A is paying upfront. Customer A will pay 10,000 rupees. 10,000 rupees. What will be the revenue in this case? What will be the revenue in this case? 10,000, right? No interest income, no interest cost. There is a customer B, and customer B is paying after 1 year. After 1 year, right? So customer B is paying 12,000 after 1 year. Tell me, what will be? Tell me, what will be the revenue? What will be the interest income? Or what will be the interest cost? Tell me. Of course, the revenue in this case will be 10,000, and there will be an interest income element, and this company has to recognize an interest income of rupees 2,000. Again, so there is a customer C, and customer C is paying in advance of 1 year, right? And this customer C is paying 9,000 rupees. Customer C is paying a 9,000 rupees, right? What will happen then? What is my revenue? Customer C is paying me 9,000 rupees. What is my revenue? Still revenue is 10,000, but we have to recognize an interest cost of rupees 1,000, because here the customer is funding my operation by paying in advance. So guys, in case of a significant financing component, first of all, you need to see there must be a financing component, there must be a significant financing component, right? So if in the question it is written that it is not a significant financing component, you are not required to exclude that amount from the transaction price. You have to take that amount into the transaction price. Or if in the question it is written that since the credit rating of the customer is getting deteriorated, okay, and the entity was expecting that probably this amount will not be received, and hence before delivery of goods, or let's say the company has taken the money in advance from that particular customer. So first of all, you need to remember and understand that this significant financing component comes into play when there is a difference between delivery of goods and services, I mean to say transfer of control of goods and services, and payment of consideration. If the difference is 1 year or more, only then this thing will come into play, right? And when you will exclude that significant financing component, I mean to say interest income or interest cost from the transaction price, when there is a more than 1 year, okay, there is a difference of more than 1 year, and there is a difference in consideration between the cash selling price and the actual consideration, and it should be at a market rate of interest, and it should be for a genuine reason of financing. Okay, if the customer, if the vendor has to secure his payments, okay, or supplier or shopkeeper has to secure his payment, and that is why he is only asking for the advance, in that case it will not be considered as a it will not be considered as a financing component, right? If you remember, I still remember you know, earlier there was a Bajaj scooter. You all have seen the Bajaj scooter or Chetak, okay? So there was a scooter, the name of the scooter Chetak, Yamaha. So earlier, you know what happens when this Bajaj scooter came, when this Chetak came. So there was a booking of that scooter for, let's say, 2 years, 1 year, 6 months booking was there, okay? And the customer has to deposit the booking money. For example, the cost of the scooter was 10,000 rupees 30 or 40 years back. So customer has to deposit, let's say, 2,500 rupees or 2,000 rupees, and he will get the delivery after 1 year. So if you see in this particular scenario, this is a business model where the company is getting money from the customer, okay, and the company is not giving any discount to that customer. So it is at the cash selling price only, and the company, why company is getting this booking amount from the customer? The company is getting the booking amount only from the customer just to secure the orders, right? So that the company will have a visibility that, okay, I'll have 10,000 orders, and so I have to manufacture 10,000 unit of goods, right? So in this particular example, the objective of this particular business model is not to get the funding, okay, from the customer, right? The objective is to secure the orders. The objective is to know how many quantity needs to be manufactured, right? So in this particular course, these companies are not recognizing any interest revenue, and this company are not recognizing any interest revenue, which needs to be differentiated from the actual price of the scooter versus the consideration received in advance, right? So in this case, whatever consideration is received by the company, that has to be recognized as a revenue. Yes, Namita, you're right. In C case, of course, that is why I have recognized 10,000 rupees as revenue. I have booked an interest cost of 1,000 because the actual consideration which I'm getting is not 10,000, it is 9,000 only, right? So in the P&L, on the top line, 10,000 will go, and in the expense side, 1,000 will go, right, Namita? And this revenue has to be recognized on the basis of fair value or standalone selling price, right? Clear? I hope it is clear to everyone. Yeah. So friends, let's move on to the PowerPoint presentation now. Yes. So a contract would not have a significant financing component if any of the following factor exists. The customer paid in advance, and the timing of transfer of promised goods or service is at the discretion of the customer. Customer has paid you in advance, and customer will say, okay, I'll get these goods and services. I'll take the control of these goods and services at my discretion. Okay. For example, the customer has given money to the vendor for procurement of a purchase of a machinery, And since the customer is not having any space in its godown, and that is why the customer is delaying in taking the delivery of that machinery. Okay. So if the transfer of goods and services is at the discretion of the customer and the customer has paid money in advance, you cannot say that financing component is there, because for the what is the objective? The objective of the supplier or vendor is not to charge any interest or not to pay any interest on the advances which have been received from the customer, right? So if it is at the discretion of the customer, the difference in the timing is if at the wish of the customer, significant financing component will not arise. And if it will not arise, you are not required to exclude this particular amount from the transaction price. A substantial amount of the consideration is variable, and the amount or timing varies based on a future event that is not substantially within the control of the customer or the entity. For example, the substantial amount of the consideration is also variable, right? So it is not fixed consideration, it is variable consideration. If the entire, or let's say substantial amount is a variable consideration, then how can you say that whether it is a payment in advance or it is a payment in delay, right? Today I am not aware that how much money I am required to pay as a customer to the entity, because majority of the amount is variable and it is depending on the future outcome of the event. So you cannot say that you are paying in delay for after 1 year or 2 years. So difference between the amount which you are paying today and the estimated amount should go to the financing component. Okay, so it will be a very cumbersome task. So this kind of theory is given there. The difference between the promised consideration and the cash selling price arising for a reason other than provision for finance. Okay, like I've told you, just to secure the order we have taken in advance. Okay, or let's say credit rating of the company is customer is deteriorating, so that we have taken in advance, right? So there was a risk, that is why the entity has taken an advance from the customer, right? Or there could be a risk where the customer can deny from taking the product, so that is why the company is securing its risk, okay, from the customer, right? So if there is a difference between the consideration and the cash selling price due to a reason other than the provision of finance, then it will not be considered as a significant financing component, right? So this is some theories which is given there. So you need to understand while solving your practical case studies, right? Yes, illustration number 38 from the Institute study material will do. So Jay is saying advanced example. Mr. Sairam, in transaction price, you should deduct the interest factor from that amount. Yes, Sairam, in transaction price, you have to deduct that. You will be able to understand with the help of this particular example of illustration number 38. So Namita is saying, sir, in C case, 1000 should also be revenue, as expected price of goods for the entity is 10K. You're right, Namita. And in C case, are you assuming 9,000 is full payment? Yes, Namita, 9,000 is the consideration. I have written in the Excel file that 9,000 is the consideration, right? Yes. So Jay is saying Bajaj example. Utkarsh is saying completely clear, sir. Fine. Shruti is saying thanks for the wonderful teaching. Thank you, Shruti. Yeah. Yes. So illustration number 38, accounting for significant financing component. NKT Limited sells a product to a customer for rupees 1,21,000, that is payable 24 months after delivery. So it means there is a difference between the time of delivery and the time of consideration. Okay. So today they are doing the delivery of this product and they will get the money after 2 years. So there is a difference. Okay. So there is a difference of more than 1 year. Now we need to see the price as well. The customer obtained control of the product at contract inception. So at contract inception, the delivery was there, but the payment is not there. The contract permits the customer to return the product within 90 days, and there is a return policy within 90 days. The product is new and the entity has no relevant historical evidence of product returns or other available market evidence. So this right to return is also a variable consideration. It's also there is a variability. But since the product is new and the entity has no any historical evidence, so the entity is not able to determine how many products will be returned or how many products will not be returned, right? The cash selling price of the product is 1 lakh rupees. So the cash selling price is 1 lakh rupees and the consideration is 1,21,000. So 1,21,000 is consideration and the CSP, cash selling price, is 1 lakh. So is there any significant financing component? So 21,000 rupees is the additional amount which this entity is charging. Why? Because there is a delay of 2 years. The payment has to be made after 2 years. Which represents the amount that the customer would pay upon delivery for the same product sold under otherwise identical terms and conditions as at contract inception. If another customer will come to this company and will ask for this product, so this company will sell, this company will charge 1 lakh rupees in an outright sale to that particular customer. But from this customer, the company charging 1,21,000. Why? Because there is a time value of money. Okay. The entity's cost of the product is 80,000. So the cost of product is 80,000. The cash selling price is 1 lakh. So it means 20,000 is the margin, right? And between 121 to 1 lakh, this 21,000 is interest income. The contract includes an implicit interest rate of 10%. That is the interest rate that over 24-month discounts the promised consideration of 1,21,000 to the cash selling price of 1 lakh. So if we will discount 1,21,000 at a present value, so it will comes out to 1 lakh rupees at a 10% discount rate. Analyze the above transaction with respect to its financing component. Tell me, is there any financing component in this particular transaction? Yes. If the financing component would not be there, in that case, it will be get clarified in the question itself, right? So yes, a financing component will be there. The contract includes a significant financing component. This is evident from the difference between the amount of promised consideration of 1,21,000 and the cash selling price of 1 lakh at the date the goods are transferred to the customer, right? There is a difference between what the entity is collecting from this customer and what the entity is charging from the other customer in case of an outright sale, right? The contract includes an implicit interest rate of 10%, okay? And the entity evaluates the rate and concludes that it is commensurate with the rate that would be reflected in a separate financing transaction between the entity and its contract at the customer at the contract inception. What is this? Nothing. So it is saying that the entity evaluates that this rate is a market rate of interest, right? This rate is a market rate of interest. Until the entity receives the cash payment from the customer, interest revenue would be recognized in accordance with Ind AS 109. In determining the effective interest rate in accordance with Ind AS 109, the entity would consider the contractual terms. For example, in this particular case, how this entity will recognize the interest revenue? So the entity will recognize the interest revenue in this way. Let me tell you. So what is my consideration, payment consideration? So it's a 0 period, it's a 1 period, it's a 2 period. I'll receive 1,21,000 after 3 years, right? And what is my present value factor? 1 divided by 1.1 divided by 1.1. So what is my present value? My present value is 1 lakh rupees. Okay. So I'll recognize revenue at 1 lakh rupees, right? Today I'll recognize bank account, customer account debit, because I'm not receiving money today. Customer account debit 1 lakh, to revenue 1 lakh, right? Clear? To revenue 1 lakh. So at the end of first year, at the time of sale, right? At the end of first year, the interest has to be recognized at 10%. Customer account debit to interest income. %10% is the interest income, 10%, and again customer account will be debited. At the end of second year, again customer account will be debited and the interest income will be credited. And at what value interest income will be credited? 1 lakh plus 10,000. This is the customer balance at the beginning of the second year, and on this balance 10% interest is required to be charged. And when the customer will pay at the end of second year, at the time of payment, bank account debit to customer account. And how much money this customer will pay after 2 years? How much amount this customer will pay? 1,21,000, right? And what is lying in the so 1,21,000, and what is lying in the customer balance? In the customer balance, this 11,000 is there, is this 10,000 debit is there, and this 1 lakh debit is there. Okay, so 1,21,000 debit is there in the customer balance, right? This 1,21,000 debit will be there. Clear? Is it clear to everyone? 1,21,000 debit will be there in the customer balance. I hope it is clear to everyone, right, friends? Yeah, so these are the accounting entries which needs to be made at the time of sale, at the end of first year, at the end of second year, at the time of collection, right? So this is what which is given in this, which is written in this question, right? So in this case, the interest revenue has to be recognized as per Ind AS 109 on the closing balances. I hope it is clear to everyone. Yes, Namita, you are right. In Excel, C also pays in advance. So there we say finance component exists, but in example where no space and go down, there is no finance component. So Namita, you need to look at the reason, right? For example, a customer, you know, in a real estate agreement, how these agreements happen. In real estate contracts, for example, I am a customer and I have given you a contract for building or constructing my house, right? I have so for example, my payment consideration or my consideration is 1 lakh rupees. I am paying you rupees 1 lakh, but I am retaining 5%. For example, I am retaining 5% of my supplier or vendor as a retention amount. So, you know, the companies are retaining this 5% money as a security deposit, or let's say retention money, so that if there will be any problem with the construction, so that I can call you and you will come for me. Otherwise, if I'll pay you 100%, you will not come to me for any damage, defect or defaults within a specified period from the date of construction. So at times customer holds some money. Okay, at times customer holds some money and customer pay that money later on. So it means, what is the objective behind this? The objective behind this is not to delay and not to get a credit period from the contractor for making a payment, but to secure the quantity, to secure the quality of that product, right? To secure the obligation which is there on the part of the contractor. If some issue will be there, so that he will come and he will get this rectified. Okay, so the objective is not to hold money for the sake of credit. The objective is to retain some portion of the money just to ensure the quality of this particular product, right? So you need to see if this advance payment or delay in payment is due to the reasons other than the provision of finance. In that case, the significant financing component will not be there, and hence you are not required to exclude anything from the transaction price. For example, in this particular example, if the significant financing component would not be there, in that case, this 1,21,000 entire money will be the transaction price. This 121 entire money will be the revenue. Okay, understood? When I am saying a transaction price, I am only talking about revenue from operations. I am not talking about other income, right? Yes. Let's this illustration number 40 again. Advance payment and assessment of discount rate. ST Limited enters into a contract with a customer to sell an asset. So ST Limited is a company. It enters into a contract with a customer to sell an asset. Control of the asset will transfer to the customer in 2 years. Okay. So the asset will transfer after 2 years, right? That is, the performance obligation will be satisfied at a point in time. So when the performance obligation will satisfy, when this transfer will happen, right? And when revenue will recognize, when that performance obligation will be satisfied, that is after 2 years. The contract includes two alternative payment options. Payment of rupees 5,000 in 2 years when the customer obtain control of the asset. So one payment option is just pay 5,000 rupees in 2 years when the customer obtain control of the asset. When after 2 years, when you will take the control of this asset, you can pay me 5,000, right? Payment of rupees 4,000 when the contract is signed. So today contract is signed, we'll give you delivery after 2 years. So today you can pay me 4,000, okay? And at 4,000, we will not charge you any money after 2 years. So ST Limited concludes that the contract contains a significant financing component. First, because of the length of the time when the customer pays for the asset and when the entity transfer the asset to the customer, as well as the prevailing interest rate in the market. So why there is a reason to believe that there is a significant financing component? Due to two reasons. One, because of the length of the time, and the length of the time is 2 years, right? Second, so length of the time between the amount received, consideration received, and the delivery will happen, or the control of the goods and services will happen. Second, the difference between the consideration and the cash selling price is somehow also reflecting the element of market rate of interest. For example, in this particular case, between the 4,000 and 5,000, there is a difference of 25%, right? Or let's say between the 5,000 and 4,000, I can say that there is a difference of 20% from 5,000. So we can say that 10% is roughly the market rate of interest, and hence there is an element of significant financing component. The interest rate implicit in the transaction is 11.8%. So it is given in the question, which is interest rate necessary to make the two alternative payment options economically equivalent. So what is the rate of interest? It is 11.8% for this particular company. Okay. And when I discount this 5,000 at 11.8%, it gives me a present value of 4,000 as of now, right? Or when I will compound the interest at the rate of 11.8% on this 4,000, it will give me 5,000 rupees after 2 years, right? However, the entity determines that the rate that should be used in adjusting the promised consideration is 6%, which is the entity's incremental borrowing rate. But this entity determines that the rate which should be used in adjusting the promised consideration is 6%, which is the entity's incremental borrowing rate. Okay. Past journal entries showing how the entity would account for the significant financing component. Friends, first of all, what is the accounting entry at the time money will be received? At the time money will be received, cash account debit to revenue. Revenue will not be recognized. Revenue will be recognized when the performance obligation will be satisfied. That is after 2 years. So today liability will be created. So recognize a contract liability, or you can say that customer liability, customer account, whatever name could be. Recognize a contract liability for the 4,000 payment received at contract inception, right? Cash account debit to contract liability, right? Simple. Cash account debit to customer's account to customer's liability account. During the 2 years from contract inception until the transfer of the asset, the entity adjusts the promised amount of consideration and accrete the contract liability by recognizing interest on 4,000 at 6% for 2 years. What does it mean? Because it says that the incremental borrowing rate, the interest rate should be 6%. Although the rate used in the transaction is 11.8%, but the interest rate is 6%. So in this case, if you will recognize 6% of interest, 4,000 contract liability, multiply by 6% per year for 2 years, it will give you 494. How come it is there? 4,000 multiplied by 6% for first year. So it is 240, right? And then 4,240 multiplied by 6%. So it will give you how much? 4240 multiplied by 6%. Let me calculate. 4240 multiplied by 6%. It will comes out at 254. 254, right? And the total comes out as a 494, right? So it comes out as a 494. So what will be the recognition of revenue at the time of transfer of asset? Contract liability debit 4494 to revenue 4494. Okay. So in this particular case, you need to recognize a revenue for the transfer of the asset as a contract liability debit 4494, and revenue needs to be recognized for 4494. So why revenue has not been recognized at 5,000 and why revenue has only been recognized for 4494? So my dear friends, if you will look at this transaction, so two things needs to be satisfied. One, there should be a length of the time period between the receipt of consideration as well as transfer of control. The second one is assessment of discount rate. If in the question, two discount rate will be given. For example, there is a discount rate which is used in the transaction is given. Like in this case, it is 11.8%. And the discount rate, which is actually which has to be used, like in this case 6% is the incremental borrowing rate, which is kind of a market rate of interest, right? You must have read this concept in the increment of asset as well. So in this case, the company has actually used 11.8%, but the company should have been used 6%, right? So in this case, the interest income has to be recognized at 494, right? It has to be recognized at 494. Interest expense is required to be recognized at 494, right? And the cost of the and the cost of the good transfer, or I mean to say the revenue which is required to be recognized, it should be 4494. It should not be 5,000 rupees, right? The 4494 is the actual amount which is required to be recognized at the end of 2 years. Clear? Is it clear? Is it clear, guys? Yes or no? Yeah. Sir, what will be the impact for the difference between 4494 and 5,000? Because the cash selling price is 5,000 and you are recognizing a revenue for 4494 only. It means the company has given a discount. Probably the customer has given in advance. So the difference between the interest and the cash selling price, probably the company has given a discount for that, right? So it's a very practical scenario. When you are paying in advance, the company is also giving you some discount, as well as there could be some financing component as well. Okay. For example, the company used to provide a discount of 10%. So the company will give this discount to everyone, for example. So for this 5,000, there will be a 10% discount. The cost is 4,500 only. Okay. And instead of 4,500, you are paying 4,000 rupees right now. Okay. So what should be the interest cost which is required to be recognized at the time of advance payment? It should be at market rate of interest, which is a kind of an incremental borrowing rate, entity's incremental borrowing rate, right? Priya is saying it is clear. Namita, is it clear? Jay, Sairam, Chota, is it clear to all of you? Yes, no? So coming to the non-cash consideration, right? Step number 3, determine the transaction price and non-cash consideration. What is meant by non-cash consideration? And you have heard this concept at a lot of places, like Ind AS 16 property, plant and equipment, Ind AS 38 intangible assets, right? This concept is there at a lot of places. What is meant by non-cash consideration? For example, let me move on to my Excel file. Third concept, non-cash consideration, right? Non-cash consideration. Now coming to the non-cash consideration, what is meant by non-cash consideration? What do you understand by non-cash consideration? Example, DLF Limited. Have you heard about DLF Limited? DLF Limited sells flat to Mercedes in exchange of 2 cars. Yeah. Of course, DLF is selling a flat and DLF is getting 2 cars from the Mercedes. Okay. So this transaction has a commercial substance. Of course, yes, this transaction has a commercial substance, because the entity is selling flat and getting two cars, getting a car. Of course, this transaction has a commercial substance. Now question arises, in the books of DLF Limited, at what value the revenue has to be recognized? Okay, so DLF is selling a flat and Mercedes is selling a car. Mercedes is purchasing a flat, which is a property, plant and equipment for Mercedes, and Mercedes is selling cars, which is a revenue for Mercedes. So at what value revenue needs to be recognized? So what is the transaction price in this case? Please write down transaction price. In this case, the transaction price is, in this case, you need to give a preference. In this case, what will the first preference? What will be the first preference? The first preference needs to be given to the fair value oblique standalone selling price of the goods received. And if the fair value or standalone selling price of goods received is not there, then what is the second preference? In that case, the second preference is, what will the second preference? The second preference is fair value oblique standalone selling price of the goods transferred. Right? So this is the meaning of transaction price. In this example, for example, the fair value of car, one car is 2 crore rupees. 2 crores, right? So how to account for this transaction in the books of DLF Limited? So in the books of DLF Limited, how this revenue is recognized? Car account debit to revenue from sale of flat. At what value? 2 multiplied by 2 cars are there, 4 crores. And what is the value of the car? The value of the car is 4 crores. So the revenue has to be recognized on the basis of fair value of the car received, right? So this is the example of non-cash consideration, right? I hope it is clear to everyone. So whenever an entity expects to receive non-cash consideration, such consideration is measured at the fair value of the amount received or promised, and it is included in the transaction price. Okay. So if the fair value cannot be reliably measured, okay, in that case, you need to see if the fair value of the goods received is not reliably measured, then you need to see the fair value or the standalone selling price of the goods transferred, right? Is it clear? Is it clear, friends? I hope it is clear to everyone. Yeah. Yes, Jay, it is without money, right? Yes, Jay, revenue as per books and as per invoice could be different. Yes, of course. Even the profit as per the books of accounts and profit as per the tax is always different now. Right? So let's do this case study, illustration number 48. An entity enters into a contract with a customer to provide a weekly service for 1 year, right? So this entity is providing a weekly service to the customer. The contract is signed on 1st April 2001 and work begins immediately. Yeah. The entity concludes that the service is a single performance obligation. Why? Because the entity is providing a series of distinct services which are substantially same and have the same pattern of transfer, right? The service transferred to the customer over time and use the same method to measure progress. That is a time-based measurement of progress. Like in case of electricity, that is a time-based measurement of progress, like monthly basis. So twice in a month, bi-monthly, okay. And in exchange for the service, the customer promises its 100 equity shares per week of a service, total of 5,200 shares for the contract. And the customer is saying that if you will provide me such service on a weekly basis for 52 weeks in a year, I'll give you 100 equity shares for every week. The terms in the contract requires that the shares must be paid upon the successful completion of each week of service. And what is the term of the contract? That this customer has to raise or has to issue the equity shares to the vendor, to this entity, upon successful completion of every week's service. How should the entity decide the transaction price? So in this case, what would be the transaction price? It is a non-cash consideration. The entity is giving a service and the customer is giving equity shares. So in this case, the transaction price is the fair value of the shares received. Is the fair value of the shares received. Okay. So what will be the accounting entry? The accounting entry will be equity shares, or let's say investment, we can say that. Equity shares or investment, we can write down investment, debit to revenue every week. Equity shares oblique investment debit to revenue every week, right? To revenue, right? And at what value? At what value? So this should be at the value of the equity share, at the fair value of the equity shares. Okay. For example, every week 100 equity share needs to be transferred and the value of one share is 10 rupees. So 1000 rupees is the amount of revenue. Okay. So the entity measured its progress towards complete satisfaction of the performance obligation as each week of service is complete. So here my performance obligation is on a weekly basis. So revenue recognition should be on a weekly basis. To determine the transaction price and the amount of revenue to be recognized, the entity has to measure the fair value of 100 shares that are received upon completion of each weekly service. Okay. Okay. So we will recognize revenue to the extent of fair value of the equity share received on a every week basis. Sir, what happens? For example, this fair value was 10 rupees when you recognize revenue and you are having this investment. Okay. So subsequently this 10 becomes 8 or this 10 becomes 12. Then what happened? Then it will not impact your revenue. It will impact your market gains and losses, right? For example, if there is a gain, your investment will be debited and your market gain will be credited. So Ind AS 109 will be applicable, right? Ind AS 115 will not be applicable. So revenue will be recognized on the basis of fair value of the non-cash consideration received at the time of transfer of goods and services. After that, if there is any increase or decrease in the value of that non-cash consideration, that will be treated as per the respective standard. For example, in my example, DLF is buying a car in consideration of giving a flat, right? So tomorrow, for example, there is an impairment in the car. So by that impairment, revenue will not be changed. So that impairment has to be checked as per Ind AS 16 property, plant and equipment. In this particular case, tomorrow the value of the share goes down or goes up. It has to be treated as per Ind AS 109, not as per Ind AS 115. Right? I hope it is clear to everyone. Namita, Priya, Tanushri, Jay, Thota, Utkarsh, Shruti. Another example, illustration from Institute Study Material. Production company Y sells a television show to television company X. So there is a company Y and company Y is a vendor, company Y is a supplier, company Y is a entity, and customer is company X, because this company Y is selling a television show to television company X. Now this television company X has to give a money to the company Y, but the consideration under the arrangement is a fixed amount of rupees 1000. This company X is paying 1000 fixed amount and 100 advertising slots. So the company X is saying, you are selling this show to me. I will pay you 1000 rupees cash and you can advertise. I can give you 100 advertising slots. So while this program will run, you can just run your 100 advertisement, right? So in lieu of this show, I am giving you 100 advertising slots. Y determines the entity who is selling this show. Okay. And what in return, what this entity is getting? This entity is getting 1000 rupees from customer and 100 advertising slots from the customer. Okay. So Y determined that the standalone selling price of the show would be 1500. Okay. So the fair value of the goods transferred is 1500. And based on market rate, Y determined that the fair value of the advertising slot is 600. And the fair value of the goods received, 100 advertising slots, is 600. And it is paying 1000 rupees also. So what is the total consideration? 1600. So first preference needs to be given to the fair value of the goods received. So what is the fair value of the goods received? For 1000 rupees, the fair value is 1000. For this 100 advertising slots, the fair value is 600. So Y determines that the transaction price is 1600, comprising of 1000 fixed amount plus fair value of advertising slot 600. So Y will recognize a revenue like advertising slots, or let's say advertising slots account debit, or let's say right to recover account debit, the cash account debit 1000 rupees, right to advertising slots debit 600 rupees, to revenue 1600 rupees from sale of television show. Okay, if this fair value would not be given for this advertising slots, in that case Y has to recognize this 1500 rupees as a fair value. And how this Y has to put an accounting entry: cash account debit 1000 rupees, right for advertising slots 500 rupees, to revenue from sale of television show 1500, right? So if the fair value of the advertising slots could not be reasonably estimated, then the transaction price would be 1500. That is, Y would use the standalone selling price of the goods or services promised for the non-cash consideration, right? Is it clear to all of you? Guys, is it clear to all of you? So friends, as far as step 3, identification of transaction price or determination of transaction price is concerned, so we have discussed the option of material right to discount as a part of the performance obligation, and of course transaction price as well. And then we have discussed what is a transaction price. So we discussed about variable consideration part, we discussed about significant financing component part, and we discussed about the meaning of or the determination of transaction price when there is a non-cash consideration. In the next class, we will discuss about consideration paid or payable to a customer, and after that this particular step will get completed, and we will have 2 small steps, which is allocation of transaction price to the performance obligation and recognition of revenue over a period of time or at a point in time. So I hope you have been able to understand today's class, where there is a step number 3 which we have discussed in detail. Okay, and I would request each one of you that before listening this particular lecture, please go through with lecture number 1, where I have given a helicopter view of the entire standard step 1, 2, 3, 4, 5 with the help of a very layman language example. Okay, so you have to go through with part 1, part 2, and part 3, which is 22nd February, 24th February, and 26th February, which is today's lecture. Okay, so thank you so much, students, and let me look at the query link. If you have any query, we can discuss. Otherwise, I'll conclude the session. Let me know if there is any query. Namita, Priya, Jay, Sairam, Tanushri, Utkarsh, Thota, Shruti. Is it clear to all of you? Let me know if you have any doubt. So we can discuss the query or doubt in the next 5 minutes, and then I can conclude the session. Thanks, Utkarsh. Thanks, Shruti. Yes, transaction price has to be determined at the inception of the contract. So at the inception of the contract, when you are entering into a contract with the customer, you need to see whether it is a contract with the customer. You need to identify what are the different sort of performance obligation. Then you need to determine the transaction price. And while determining the transaction price, you have to give weightage to, of course, fixed consideration as well as variable consideration. Variable consideration could be positive, could be negative. And you have to ensure that variable consideration needs to be measured in such a way that the significant revenue reversal will not occur. Okay, will not occur. And while determining the variable consideration, you need to see whether there is a multiple outcome of a single event or a binary outcome of a single event. If it is a multiple outcome of a single event, then you are required to apply expected value approach. If there are a binary outcome of a single event, you need to apply a most likely approach, right? Okay. So generally in the case of FMCG companies or industry, where there are threshold kind of limit, okay, for volume rebate. So in that case, expected value approach is more appropriate. But for example, when there is a bonus on the basis of quality, you cannot say that if the quality is 10% right, we will give you 10 rupees. If 20% okay, we'll give you 20 rupees. So in case of a qualitative things, okay, in case of a things where quality is at most important, and if the customer is paying an incentive for that or a penalty, charging penalty for that, so it could be a binary kind of outcome, and most likely approach is more suitable. In case of a significant financing component, you need to see what is the logic behind the consideration is different from the cash selling price. If it is due to the provision of finance, of course, you need to recognize interest income or interest cost, and you need to exclude that amount from the transaction price. For example, in my example, 1,21,000 is the consideration, but it is not a transaction price. Why? Because this is having a significant financing component. So out of 1,21,000 consideration, 1 lakh is the transaction price, and this 21,000 is the interest income, right? So Namita is asking a question, sir. If ABC Limited policy is that if customer give old bike, then 20% reduction in new bike price, then we need to do the fair value of the old bike. Yes, Namita, you're right. Generally, this is a real life example where the companies, automobile companies, are exchanging the old car or old bike. So they are doing the fair valuation of that while recognizing a revenue. So you are right, Namita. Then we have discussed the concept of after variable consideration, significant financing components, and non-cash consideration. In the case of non-cash consideration, you have to recognize revenue on the basis of the fair value or standalone selling price of the goods received. If it is not there, then you need to recognize on the basis of fair value or standalone selling price of the goods transferred, right? So the last part we have left today, which is consideration payable to a customer, which we will be taking on the next session. So thank you so much, and thanks for the confirming that you have understood today's session. Stay happy, stay healthy. Bye bye. Take care, students. We'll meet in the next session on part 4 of Ind AS 115. Thank you so much.